And so you realize that this space is also quite personal in that people also do back life science companies which relate to illnesses which come across with family members. And that's been very, very common in this space for a long time. And also what we know is with these companies, whilst they do take capital to actually get to this stage, and whilst they do take time to get to it, there comes this curve when, from an adoption perspective, where investors really start to see the gains and the take-up and the acceleration of take-up in the companies in which they're backing. And this is why we always like to refer back to the adoption curves, because whilst it does take time, so when they do take place, it's incredible to see the transformation. And I'll give you a perfect example. One of the companies that we work with back in 2017, 2018 was a company, little known company called Imugene at that time. And I remember they did a presentation at one of our events and their share price was 0.007 cents. And I was like, I remember an investor come up the back to me and said, I've actually just put in a buy for that because I'm pretty sure that can't get lower unless it goes out of business, right? And that was pretty much the Australian mindset, right? It's like, let's have a punt, right? And then you see that company to go to 2021, that height when it went to up to, over $2 billion market cap, and we started working with them at a $30 million market cap. And to me, that what becomes exciting about some of the ASX listed companies is that when markets do go through that sort of cycle of that bullish cycle, right now it's obviously been a bear cycle for the last sort of 12 to sort of 15 months. Really, you start to see, almost returns with small caps as what you were previously trying to look for in private companies, where you can get that sort of 5x to 10x in the small cap market. And that's the volatility that goes with the innovation space, but also that's the downside and also the upside opportunity. So I won't go through these slides because I saw them. Okay, so today we've got some fantastic speakers across a bunch of different areas. So we're very happy to have Amit from the ASX to come and talk about some of their initiatives and what they're focused on from the year ahead. I've known Amit for a long time, and to me, I love that they get involved in activities like this to create sort of more visibility for the early stage companies. Friska, I've invited a good friend of mine. You may have seen her content online. She recently did a TEDx talk, which was quite, circulated quite strongly. And basically everything she's focused on around is innovation amongst sort of inside corporates and what that process is and what that looks like and what the upside potential that comes along that with. So I know everyone will enjoy her presentation. And then also Toby Norton-Smith, from X15. The Commonwealth Bank has invested a lot in the innovation arm, which is the actual X15 arm. And he's going to be doing a presentation on some of the initiatives of what they're focused on and how they're taking an approach to innovation and what they're expecting from their side and how they can utilize basically innovation and then correlate that across some of the bank's assets and distribution networks to create and to roll out amongst their customers. So they'll be on stage 2 straight after I finish my actual presentation. And then Peter Mobbs, as I said, I can't talk about Peter highly enough. Every investor needs to have a listen to his presentation. I said, before I started speaking to him, I didn't really think about the edtech space too much because it sort of hasn't been on my radar. After listening to him, I said it really grabs your attention about what comes next in the innovation space. So that's going to be the keynote speakers for today. Different panel sessions. Obviously, the small cap investment trends. Got some incredible guys coming along. Obviously, Niv, you guys may know pretty well. We've worked with Niv for a number of years. Also, Rajiv from Alien Capital is also coming along as well. And I'll be the moderator for that session. So super excited to be hosting that. And then obviously some of the corporate finance and M&A trends that it's expected to come for the year ahead. From the presentation, so that's in presentation room 1, which is this room. Presentation room 2 across the other side will be alternative fund investment opportunities. As I said, we're very well aware that that's been a focus for investors, whether it be the desire to back either fund managers or the desire to access yield opportunities, etc. But that's been a prominent theme in our ecosystem for the last sort of 12 months. So that's going to be across the different panel sessions. For the founders that are joining today, we've got a masterclass at 9 a.m. with Sales Director Central, which is taking place now. Then We Connect, then Cashcade at 10 a.m. and then syndicated investment opportunities at 11 a.m. With Andrew Ireland. So we've got a big day lined up. We will be finishing early. We'll be finishing probably about sort of 3 p.m. And as I said, it's funny how hard, I said this in a joke yesterday, it's funny how hard we have to work to bring people, to the event and make sure people show up. What's always amazing is how at 3 and 4 p.m. when we start to host the drink session, how easy it is to get people to turn up. It's always a funny dance when you do it. But what makes this thing beautiful from when we actually run it, and I'll go through the sponsor in a second, is that typically what we find is that the formalities of the 2 days is really nice. Everyone's connecting. There's a great buzz and energy. It's incredible the deal making that gets done when the drinks come out. A big thank you to our partners, Stake. I gave a lot of talk yesterday for the likes of WeConnect, Audicon, who I think are incredible in what they actually do. Flav, I'm sure you guys have all been, I'm sure everyone was surprised about how delicious the food was from Flav yesterday. For me, I just took my family there on the weekend. We absolutely loved it. Pacific Channel, said Stephane's here, said incredible guys. The one I want to mention today is just Stake. Said, cannot thank them enough for the support of this event and how they've invited their ecosystem of investors and traders to actually watch this. As I said, sometimes it's incredibly hard for small caps to get visibility. So when you have a platform that's so willing to actually create that visibility for small, early stage ASX listed companies, that's a big win for those companies. So big thank you to Stake for the event. Obviously, I recommend to check them out as well. So they basically said they've done a great job in simplifying the trading aspect and making it quite cheap. And so obviously, Sales Director Centrals, Sheffen in catering the VIP room. I said, I know two different things, two different styles of food. I said, that's what I love about doing it. But they said for years they've been catering our VIP room, and we always get incredible feedback from people about how much they love the food, how much they love what those guys do. And likewise with all things with WI, I said, guys like Sheffen are available to invest in. Flav is available to invest in. So I'll just clarify, Stake is not raising money. They had some big backing you probably would have seen in the media last year, just to be clear. I think they received about 90 million and had Tiger Global leading it. And then obviously, as I mentioned about Pacific Channel and then Sales Director Central, so we cannot thank these guys enough for their support of the event. And the reality is without the companies that get featured today, without the sponsors, none of this takes place. So a big thank you to them. So the thing I asked for this, and just my final slide, actually, it's not my final slide. One thing, basically I really always ask is that what's beautiful about the WI ecosystem is that one person always has 10 to 15 people in their network that are relevant to the companies. I invite you to either bring them along today or I invite you to introduce them to a company which you think may be relevant for them. So, I said, even if an opportunity is not relevant for you, it's always asking yourself the question, is this opportunity relevant for someone in your actual network? From our perspective, we've put the entire conference on the CRISP software, which I'm sure you guys would have accessed over the last couple of days or been messaging back and forth. Simply just log into app.crisp.io. Basically, the way we've thought about this is everything we want to do is just to simplify the engagement between investors and companies. We want to streamline it, we want to standardize it, and we want to make it so that everything becomes almost uniform in such a way that people get access to what they want instantaneously. And whether it be the frequently asked questions, whether it be the documents related to the companies, whether it be the news and milestones that they've achieved, all that is just designed to be simplified so you don't need to ask for it. And then same with the matchmaking. I want you as an investor to see the most relevant deals for you. Post the event, just so you know, what we'll be doing is we'll be actually automating emails which actually go out from the CRISP platform. So 3 times a week you'll see emails, and effectively they'll be relevant to you. So as I said, we've worked really hard over the last couple months to basically get it to the point where we actually stop curating emails. We'll pretty much only look to send out our weekend newsletter and then obviously the dedicated features that we do on companies. Outside of that, it will actually be driven directly from the CRIS platform. And the idea is just, we want to focus on that topic of relevance. We know that people want to look at deals that are relevant for them. And that's the only way we could do that is through a platform approach. So the three principles have been, how can we build software which lets the ecosystem do what it naturally does? Said, the more time you spend on the platform, you more you can appreciate all the sort of UI, UX design thinking that's gone into it. The second one is build a scalable. So if you go into the actually investor networking room, you'll see there's not only investors from Australia, you'll see there's actually investors from ASEAN, you'll see there's investors from Canada, and also you'll see there's a lot of investors from the UK as well, because we've effectively brought the entire ecosystem together inside that actual platform, because that's really said everything about what we're doing is just creating a global opportunity and removing friction from the actual process. I won't mention too much about that because you've experienced it. As I said, my last point that I always like to highlight is this whole space is about one conversation and how it can change the entire trajectory of a business. And so everything we want to do is to facilitate that over and over again. If we can provide an introduction that's relevant for you, if we can actually connect you, if we can facilitate a conversation or facilitate a discussion, that's what we're aiming to do. So for everyone, I've got 15 seconds left. Thank you for joining day 2 of Emergence. I'm sure you're going to have a great day. As I said, we've got networking drinks sort of from about 3:30 onwards, something like that. Toby Norton-Smith will be presenting on the second stage straight after I finish. And obviously, we've got the panel session coming up in this room as well. So thank you, everyone. Enjoy Emergence day 2. So I'm going to get Shelley to please come up and give an introduction. Thank you.
Good morning, everyone. I'm Shella, and I will be your MC for today. We've got an exciting lineup of speakers, panels, and discussions for today. And on that note, I'd like to invite Matt Lebowitz from Stake to come up. Thank you.
Hi, everyone, and thanks to Steve for putting on the event. Looks like a lot of fun yesterday. I seem to have missed out on it, but I'll soak a little bit up today. The way I'll do this today is I'll just talk a little bit about Stake, a little bit of my journey to get going. But before I get cracking, quite a few Stake people around. Laura, thank you for organising this. I know Mal and Kira and Sergio put in the hard work yesterday, and you'll see them around today as well. So hope obviously there's a little bit happening on the screen here, but just by very simple background, Stake is an online brokerage that opens up opportunities for self-directed investors. We're now the 4th largest broker in Australia. We started in 2017, but what I'm going to talk about is a little bit about my journey, how it's probably similar to quite a few of you. I started way back in the day, maybe not this similar, but I grew up in Perth actually, came over to Sydney for uni and went to UNSW and sort of haven't left. I went to the US for a number of times for uni and work and ended up working at a large law firm, Allens, now Allens Linklaters, and I think my maths probably got me into law school. I sort of did what my mum said and became a lawyer. Realised that wasn't quite for me and ended up at a company called Optiva. It was a derivatives trading platform or a market maker, as some of you may know of. I turned up in a suit and a tie straight from the law firm, I remember, and there was a dude rolling around with no shoes on a skateboard. And I thought I'd better hide my tie pretty quickly. I couldn't get rid of my jacket into my pocket. But anyway, I did a maths test, ended up just saying, well, this is exactly what I'm going to be doing all the time. Like really quick, sharp maths. It was 80 questions. You had to get it done in 8 minutes and you got negatively marked. You had to get over 60. So it's called the barrier test. It was pretty difficult, but absolutely loved it, and then went on and had a 10-year journey there. I ended up running the index team in Chicago, which was the S&P 500, the NASDAQ. The Dow's actually not much of an exchange, even though it gets referred to a lot. The Russell 2000, the VIX complex, had 40 developers and 40 traders. managing probably the largest team in the whole business, and then ended up spending about 3.5 years there in the US, and just saw the amazing opportunity there was in the US. We actually got paid to trade. We provided liquidity. The exchange actually sent us a rebate to create, a lot more liquidity in the market. And came back to Australia and was running institutional trading. So trading after the Dodd-Frank situation, hedge funds could trade with banks, but banks wouldn't want to keep that risk on their book. So the banks would then call me up and dump it on me, and my team had to deal with it. So what I was seeing was this amazing opportunity to bring Australian equities, Australian investors access to the US. And when we started, I tried to fill out a form with one of the large banks, and it was just paper, it was cost, complexity, fees. It was actually hideous. And I thought, actually, we're really underdoing ourselves as a country if this is the best we get. Australia's, it's 2% market share in the world in terms of equities, and Australians couldn't invest overseas. I remember starting and speaking to a bunch of investors and just trying to get a sense of what was happening. And 3.5% of Australian self-directed investors had invested overseas, and people laughed at me and said, there's no opportunity. I think it's now like 17% of all Australian investors actually have a global exposure, and stakes more than half of that now. So, we changed the game. But anyway, I go back to it. So when we started Stake, it was really because I believe in the power of people, individuals, to get what they want out of the world and give them access to opportunities. So whether that be, I'm a really deep believer in founders, in self-directed investors, people that take their own risk. Actually, one of the people I've invested in is back here, Ethan, over at Fundable, a really interesting company. Go have a chat to him. But yeah, we set up Stake as a mission-led business. It was really, really straightforward way of giving individual investors the ability to do more. If you want to go from A to B or B to C or C to D, we give you that opportunity to do that. And we want to break down the barriers so you can invest in things that matter to you or opportunities that excite you. And we'll constantly do that. We obviously started with US equities really simply back in 2017. We were bootstrapped, literally just trying to build a trading platform with no venture money is pretty difficult, but we got there. And we sort of grew into, as I said, the largest US brokerage. We're the largest player for international equities in Australia now, over 500,000 Australian and New Zealanders, over 550,000 in our community globally. And so we started with US equities, really simple access. You can open an account in 5 minutes and have your money on the way to the US. So if you want to buy Apple, Google, Tesla, or you want to do Raytheon or something really interesting, if your kids want a Disney or you want to invest in a uranium ETF, you could do that just in a matter of minutes. It was easy to. Stake had a very simple premise at the beginning. We want to make it easier for you to open up an account and invest in the US than it is in Australia. I think we still do that. So check it out. So there's obviously a bit playing there. So our core focus was really making it really simple, exciting product. We really want to celebrate the investor. I think there's something that says something about you when you invest your own money and you take risk and you want to grow it. I think there's an identity in that, and I think Stake really celebrates that. So we really built, I think, something pretty compelling. We sort of lead the charge for Aussies going into Wall Street. We grew so quickly, we started getting quite a bit of knocking on the door from investors. So in 2021, we actually had a term sheet just put to me. I can tell the story because it's pretty funny. I got it checked and I'm like, this doesn't make sense. So I went to Tiger and literally, there was a rumor that they'd turn around in 24 hours. It was actually 15 hours. They turned around and sent us something back. And anyway, we ended up bringing those two investors together, did our first round for $40 million. And then a few months after that, a different investor group, we never really went out searching for money. We just had sort of, had built the product based on what customers needed. We got another term sheet from a different investor that said, why didn't we know about this? And it's like, well, I didn't go out asking for money. And we were lucky enough that people saw what we were building. The fact that we were mission-led, really just about providing that sort of seamless access to opportunities. So obviously we've got a big, broad mission that just, and I think it really aligns with what Steve's doing, is giving people access and sort of connecting investors to opportunities and companies to investors. I think it's really important that we remove that friction and make it more seamless for people to do great things. To run a business is hard, to take risk on investment is hard. We just got to make it easier. You should be focusing on your opportunities, not on the paperwork and the platform. So we've sort of built that sort of gateway for you to do that. And now we've obviously grown over the journey. We've got 125 staff. We started with US equities. We grew so quickly, and a lot of our customers were using CommSec or NAB or ANZ or sort of the bank brokers, and they came to us for that great access to the US market. And they started saying, we need our Aussie equities next. So we were really just like refining our craft. We spent 4 years just doing US equities, trying to be the best at it in the country. And then we launched Aussie equities in 2021, the end of 2021. And sort of now we're still growing really well. Obviously, we've got Aussie equities there. It's sort of low cost on HIN. It's really important that people have registered on their holder identification number. So really fast growing. I think we'll probably be the fastest growing in Australia. You never quite know, but I feel like we are. And that we just built out an Aussie equities platform that sits next to the US and really just trying to capture market share and give people an ability to have everything in one spot. And as we start to roll out, we're starting to do even more. So Kira's here from the super product. What we were seeing was our customer average age, probably a little bit younger than you, no disrespect, was 32 years old. But there was a group of them that were sort of in their late 30s that have wanted to set up an SMSF or wanted a more simple place to do it. We're going to their accountant and it was like, whoop, like $4,000. It was paper. It was lots of documentation. It was back and forth. They didn't quite know what was happening. And so we used the same philosophy of making it simpler to do something without all the headaches. We built an SMSF administration platform. It's not for everyone. For those that have wanted to set up an SMSF or want a more simple place to do it, we've done that. So we're starting to go down the product curve. And really, as I said, we're just building for investors, people like you that want to, look at opportunities, get excited by investing, really want to be part of something, and are able to, extend what you do further. And with that, obviously, comes the ability to connect with companies as well. So we'll go further down that later. In terms of Stakes journey, we're obviously, as I said, well capitalised, well funded, well growing. We're very much mission led. I'm an investor, much like you. I want to just see what's possible, see how far I can take it. I see it as a craft. And there's really not much more to it. We just, as I said, we're totally customer led. We're product focused. We try to build really great experiences that bring investing to life and allow you to just focus on the opportunities and not worry about all the other crap you normally have to deal with when investing, the paperwork, the complexity, and the fees. So it's been a great journey. It's been tough at different times, as like anyone growing their own business would know. But I'm pretty proud of where we're at. We've got a great team, and it's great to be part of an event like this. So I really appreciate it. We'll be around. There's lots to explore. I'll take in what you guys are doing as well. I know Mal is looking at a few things, talking to people. Kira's here as well. If you're looking at your SMSF, I want to understand more, and I think our booth's back corner. But really appreciate being here. Amazing opportunity to meet you and see what you guys need, and we'll be building for you in time. Thank you.
Thanks very much, Matt. And as humbly as he speaks, congrats to him on building such an incredible, fast growth business. Said to get 550,000 account holders in such a short time is incredible. Okay, next step. Can we welcome our panelists to come up? Okay. All right, so Matt's finished nice and early. Okay, so basically for this panel session, we're going to be focused on, as I said, small cap investment trends. So we've got Niv Dagan, who's the founder and executive director of Peak Asset Management. We've got Rajiv Gupta, who's a partner at Alien Capital, and Luke McFarlane, who's the co-founder of Vicara Capital. So welcome, gentlemen. First thing is, can everyone just provide a bit of an introduction to yourself and your businesses as a first step? Or your fund, sorry.
Yeah, hi, everyone. My name's Luke McFarlane, co-founder of Vicara Capital. Vicara is a long-only investment strategy focused on Web3. So it's a digital asset fund. So when we talk about small caps today, some of my answers are going to be skewed towards the next iteration, or what I think to be the next iteration of e-commerce. It's a little bit of a different model. But the way I think about it, it's investing in small cap tech. My background, I've spent the last 16 years in capital markets. I started in Victoria in corporate finance. I lived in New York for 8 years, and I was working at Macquarie on the sell side, and then the last 10 years has been on the buy side. I worked with Millennium Management, which is a $60 billion hedge fund in New York. I worked at Balyasny Asset Management, which is an $18 billion hedge fund, and most recently I was back here at Platinum Asset Management, which is a $20 billion hedge fund here in Sydney. So basically tried to take my background and put it into digital assets is what Vicara is all about.
Yeah, hi everyone. My name is Niv Dagan. I'm the Executive Director of Peak. We're a boutique investment management corporate advisory business, Melbourne-based. Did spend a few years in North America, in Canada. That's opened up the North American market for us. But Our model is identifying great deal flow that investors traditionally can't get access to themselves, that we co-invest alongside them, same price, same terms. A lot of IPOs, placements, capital raises and small caps, and then we help the companies beyond capital. So if we can institutionalize the register, if we can help them on and updating a pitch deck, if we can do an interview through a panel discussion, anything that adds value beyond capital, we take a position ourselves. So we're 100% aligned with the company and with the investor.
Hi, I'm Rajiv. Thank you to Wholesale Investor and Steve and the team for organising this event. I started my career in investment banking, did that for 10 years in North America and Asia. After that, I worked for a family office investing in technology, which I'd done previously as well. I then built a technology firm, which we sold off to a Middle Eastern investor in 2016. That precipitated the move back to Australia, and we launched Allium Capital, which today is a $500 million crossover fund, which means we do public and private investing, technology focus, and ultimately we want most of our companies to try and undertake an IPO.
Fantastic. All right, Jen. So to start off with, how have you guys seen the small cap investment landscape change over the last few years, and what do you see as some of the biggest trends for sort of 2023?
So small cap investing, I think, is evolving really quickly. And what I've noticed in digital assets is that there's 22,000 digital assets currently out there. And so as a new ecosystem for looking for, returns or the potential of returns, I think it's a great place to go and have a look. I'll be very candid. Most of those are going to zero, and they probably don't have a business proposition that works long term. But that's like most small cap markets, in that you need to dig deep, you need to do your diligence, you need to understand who you're dealing with and who's running those businesses. And you need to go and put your thesis together around what the actual marketplace for these ecosystems are, or these business models are.
Yeah, I mean, I started my career at Macquarie in 2005 and saw the GFC, and that was a good sharp awakening. I mean, look, small caps in the last, probably more specifically the last few months, obviously post the whole Russia-Ukraine saga, and then interest rates, inflation, cost blowouts, and now just, with banks, regional banks falling over, it's probably the hardest small cap market I've come across in a long time. A lot of the liquidity in equities, in terms of the buy-sell depth, has really dried out. We just caught up with a few fund managers yesterday, catching up for coffees, and I mean, any news flow is just getting sold into. So we had a dinner with a few guys here. Steve, you're one of them, and some debates about where interest rates are going, and some around the table saying, double-digit interest rates, which is interesting. So yeah, look, it is a tricky market. We're hopefully to see, additional liquidity come into the market, Fed printing money, but on a debt to equity ratio or a debt to GDP ratio, where as investors and as people, we're probably the most leveraged we've ever been, which is scary.
I'll give some perspective on small cap in public and private. So on the private side, as we all know, it's been really hot. Everyone wants to put $50,000 to some private company somewhere in Australia or elsewhere around the world that's involved in technology. I think, to Luke's point, many of those people that put $50,000 to a company will probably be, there'll be many, many zeros. I would not be active in the private space investing in technology right now. I think there's a lot of downside in the private markets. In public markets, we feel it's the complete opposite. There's been an amazing run until probably the end of November 2021, and 2022 was hard for everyone and every company. But we're starting to see some really good companies that no one wants to touch that are listed on the ASX, and that's exactly when you should be looking at them.
So Rajiv, for you, you mentioned that you've got a bit of a focus on, basically investing in companies that are going to go to IPO. How does that sort of impact your thesis? Are you still looking at opportunities that are pre-IPO, or are you just focusing on listed at the moment?
So on the pre-IPO, 2022 was a horrible year. And the reason why I say that is, for us, we're very value sensitive. Many deals were coming to us on a Monday at 9 a.m. And then you'd do some due diligence for a couple of days, which is not enough. And on Thursday, you'd get a call from either the company or the banker or advisor saying, this is going to close on Friday at 5 p.m. They were raising $10 million, $8 million's done. Do you want the last two? And we said no to 612 companies in 2021 and 2022 because you just can't conduct your due diligence within such a short time frame. How has it changed? I think the quality has gone up. People that want to raise money has gone down, and that's a damn good combo. There were no listings post-January of 2022, right? So we had one company that did list in January 2022, and it was horrible, but that's when things were starting to roll. We had nothing list last year, and if you speak to the ASX, which we do weekly often, and a lot of the banks, there is a lot of pent-up demand. Once Virgin comes, and if it does relatively well, we believe the market will open up, but it'll be a completely different company that lists. The tail end of the last bull market until 2021 was a lot of junk listing.
Yeah.
You'll need quality, and it's not about growth anymore. It's about conversion of revenue to profitability, right? So the way that people talk about a company is going to change. I think the venture community where we play in somewhat, I mean, they've just created so many bad habits for companies. Right? Those bad habits have got to go.
I'll ask about those bad habits towards the end because that could be a bit of fun discussion. Niv, you obviously, you know, part of Peak's mandate is that you have the strategy where you co-invest alongside investors, you know, with opportunities. So, how does that, you know, you obviously typically participate in placements, and so for you in that smaller micro cap area, how does that sort of adjust your thinking and your own strategy and how you actually work with some of the companies that you actually back?
Yeah, a lot of the time we're sort of top shareholders of the companies, which is good and bad because when we want to get out, we have to disclose it. But I was having a chat over breakfast with a new client this morning, and you know, we're talking about a company called Avenira. And for those that are listening, Avenira have got one of the largest phosphate deposits in Australia, in the highest grade, and Tesla has made it very vocal about moving away from lithium-ion batteries into phosphate. Just because it's cheaper and longevity and other reasons. But we backed them at 1 cent with listed options. We then got them in the Australian Financial Review. We got in interviews. We institutionalised the register. We got some momentum in the stock. And the CEO rang me up 2 weeks ago, and he said, "Niv, we did an analysis on the register, and we've noticed that 90% of you and your investors are out." And I said, "Brett, you know, the stock went from 1 to 4 in the space of a month. You know, in this market, that's a good return. Your stock's back at 1.2 and you need to raise money again, right? And you want that longevity with your investors." And so these are the type of discussions we are having. It's a tricky market, but I think loyalty has really come off. I mean, gone are the days we sort of buy and hold and, you know, there's just no loyalty anymore in small cap market. There's, you know, you're in, you make money, you have to get out because otherwise you'll get hurt. So timing around holding the positions has changed, and the investor mentality has also changed a lot.
And Luke, just going to you, you mentioned about obviously some of the tokens may not exist, you know, a few years, that makes sense. But really, you know, obviously this year has been a pretty good start for crypto markets. And so I suppose for you, from a thematic perspective, what are you actually focused on?
Yeah, so I guess from our perspective, last year was funny because crypto markets were down somewhere between 80 and 95%, depending on which token you're looking at. But we get daily data on adoption, on the number of users, the amount of commerce being done. And our average token that we hold, their growth was somewhere between 10 and 50-fold higher year over year, 2022 versus 2021. And yet you'd see their equity value completely crushed. It's a function of, I guess, it's an unsophisticated market. It's a very retail-dominated market today. And as an institutional investor, having real-time data, there's a lot of alpha to be had there. There's a lot of opportunity to be had there if you can get the right token. And it goes to a lot of the discussions we're having, which is your access to capital is different in Web3 versus it is in Web2, or when we're talking about small cap investors. It's not about going every 3 months, having an announcement, raising more money and keeping moving forward. These are equity funded models, and that equity is trading 24 hours a day. It's much different than the way a traditional equity trades. So from a thematic perspective, Web3, to boil it all down, is about how you monetize your data or your time or your experience on the internet. That's all it is. It's that simple. And how we think about it is that, you know, I'll put it this way. There's a $1.3 trillion personalized market personalized data market today annually, and it's grown at 25%. And today, not one person in this room monetizes anything that they contribute to the internet, or more or less, you know. And so I think in 5 years' time, all of us will monetize somewhere between 5 and 20, 30 grand a year by the contributions we give to the internet. And that's as simple as you sharing your location on your drive to work to let us all know what the traffic looks like, or you know, you actually putting your search results instead of into Google into a tech app that actually allows you to monetize that because you're training a learning model. Or you know, you think about a current songwriter today that records a song, they give it to Spotify, and Spotify keeps 90 cents in every dollar that songwriter should earn from the listens that they get. You know, in the future, it's not going to happen like that. Songwriter will put it on the internet and they'll get paid 85 cents in every dollar that they're owed as a function of their creativity or their time, you know. So from our perspective, it's about sitting there and saying, what does tech look like today? Where are the big oligopolistic industry structures that don't need those margins? And where can we actually decentralize and create value by taking that market share from them? That's where we're focused.
Very interesting. Rajiv, go back to you. So obviously you backed a lot of companies, you know, over the last sort of, you know, since 2016, 2017. Some of those have gone on to list. I imagine some of the, how are you, I suppose, guiding founders to navigate this next period of, I'm sure you've got portfolio companies that are wanting to list at some stage. What signals are they looking for? You mentioned about the Virgin sort of IPO. What other signals are they looking for from an innovation? Because obviously innovation stocks have been hammered over the last 12 months. That also represents a potential opportunity for investors over the next few years. What's your, I suppose, what's your guidance to the founders, and what's your guidance to your own sort of LPs?
Two things. So number one is the financials that a company shares. In the past, no one's really tied to them if you're unlisted, right? So people throw out these forecasts, they don't meet them. Generally, they miss by 90%, and there are no ramifications. If you're in the listed world, you've got to give guidance. There are ramifications because your stock gets hammered. In the private world, that hasn't happened. So one of the key things that we tell people is just model your financials more efficiently and more truthfully. The second thing that we're telling them today is try and get to a point whereby you can show profitability within the next 12 to 18 months. So that point that I made earlier about it's not about growth at all costs. It's about conversion of revenue to gross margin, to operating profit, to NPAT. That is absolutely critical. The venture community has had it far too easy. They have supported far too many businesses with far too much money at the wrong price. So if they start to cull and do less, capital will become more efficient, and it should go to the businesses that are run by people that want to build a long-term sustainable business and ideally list on the stock exchange.
And for investors that are looking at small caps and innovation small caps as a space, do you have your own thematics which you're focused on as far as from sectors or business types, business models, or is it just purely on those sort of fundamentals that you highlight?
It's on fundamentals, Steve.
Okay.
Right now, there are several businesses that are listed that look amazing. I think private equity, who has been aggressive in calendar 2022, will probably get more aggressive in 2023. And they will probably buy businesses, right? So Nitro's gone, Tyro's gone, Elmo's gone. There's so many businesses that will be taken off the markets. I do feel that, you know, there's businesses, as an example, which we're not involved in. Like there's a company called Damstra, I don't know if anyone knows it. That listed, I think, at 120 mil market cap, does $40 million of revenue today, went up to 220 million. It's now down at $20 million market cap. And you know, I spoke to the chairman a couple of weeks ago, and he's like, "Should we go private?" I'm like, "Jesus, you can try, but you know, why would the retail community and small cap fund managers not be looking at businesses like that?" And part of the reason is, I think the AFR wrote about this in January. So many fund managers have stopped doing micro and small cap, right? So we need those participants to come back, but prior to them coming back, it's individuals that should be buying things like that.
I was going to say, by the way, this is the kind of thing for us as well. This is what I love about the relationship with Stake as well, because these opportunities represent an opportunity for some retail investors as well, if they can get visibility over what's happening with those companies. Niv, you obviously, you support companies. You sort of, you mentioned no, you mentioned that sometimes it can be a shorter time investment. Other times, I imagine you have to basically, basically there's a placement done, share price goes down, and then you have to basically set in to actually, help rebuild the value in the company. When a company is going through that process, how are you working with the CEOs, and what should investors be looking at for potential upside in companies that may be going through challenges now, but have good upside, with changes being made, etc.?
Yeah, good question. I mean, what Rajiv mentioned, we're actually having a chat with one of our portfolio companies regarding delisting. We are seeing sort of small cap, nano cap companies to list cost $400,000-$500,000, just the operational cost for a small cap. It's a lot of money. It goes all to the EBITDA, right? So, the ASX, if the small cap companies don't use the ASX to promote themselves well in terms of organising a webinar or releases or news flow, there's no point of listing. Sometimes it's better to stay private. And some of these private equity guys with strong balance sheet, I mean, there's more cash now than there's ever been, right? So it's not, for example, there's no money, just investors are, in terms of private equity, venture capitalists, you have to look for great opportunities to invest. And the US dollar is obviously strong as well. So it's a double whammy relative to the Aussie dollar, and that's what probably we will see a bit more consolidation going forward. But yeah, look, we've got a lot of companies right now that are trading below where they should be. I mean, relative to NTA, or a lot has to do with momentum. It is tricky. I mean, you need to get on the front foot with them, whether it is organising lunches, organising an updated pitch deck, doing a panel discussion with them, getting a new investor eyes. I mean, what we saw in 2020 and 2021 with that plethora of retail investors and the whole Reddit crowd essentially was just truly amazing, where power came back to the people to really influence. That retail investor now, I'm not saying necessarily it's been burnt, but because of crypto and because of the small caps, is really sort of shy away from it all at the moment. So it is important to get that retail following, get liquidity back. But I think until really interest rates do start to fall, or there is that certainty that interest rates will fall and inflation's peaked, the retail investor, and you've seen that a lot. Look, I'm involved in, there's WhatsApp groups, there's Facebook groups, there's some Facebook groups with 60,000 members, right? I mean, those Facebook groups, and you can see that activity and plot that activity is dropped down from up here to there. If you speak to potentially the Comsex or the stakes or the open markets or the self-wealth, that trading volume has really dropped off. So the key is just how do you engage that retail investor, and companies, there's over 2,500, 3,000 stocks listed on the ASX, right? So you have to stand out from the crowd. That's critical.
I suppose, Luke, goes the same to different tokens and different crypto projects. So I imagine for you, it's spending a lot of time on Telegram groups. What is the what is the noise that's coming out of those different Telegram groups right now? Obviously, we've mentioned the likes of the collapse of Silicon Valley Bank and at that sort of time, obviously more and more arguments get made for the likes of Bitcoin, etc. What's some of the noise that are coming out of those groups as far as what they're thinking 2023 holds, and are we out of the crypto winter? We do have obviously the Bitcoin halving. Is it April, May next year? Like what's some of the noise coming out of those groups?
Yeah, look, I feel like we're in a circumstance where it's just one trade at the minute, and it's everybody versus the global central banks that are just looking to slow growth, basically. And so if you think about small caps, a lot of that's funded by excess speculation, but that comes from a function of having your housing equity go up, having a little bit of excess cash around because, your equity value somewhere in one of your investment portfolios moved. When I actually interact in the crypto community, like when we talk about Web3, it's about data and monetization of your data. When you talk about Bitcoin, you're talking about separating the governance function from the people that print the money effectively. That's what that debate's all about. And so when you think about these, I guess, securities that are currently sitting on banks globally, it's here in Australia, it's not just the US banks, they're hugely loss-making mark-to-market. They are assets on a balance sheet that are marked at par, that are not trading at par, and they're supposed to underpin the deposits of those institutions. And so there's something like $2.2 trillion of underfunding in the deposits in America right now, that if you went to your bank to get cash that you'd earned, you'd paid tax on, and you'd put into your bank, wouldn't be there, And I think what we're all facing here, and I think what we're all likely to face over the next 3 months, is a banking crisis, because the communities that at least that I'm hearing from are getting less and less trust in their traditional institution that they've held money with, and they've got more and more interest in having their own self-custody moving forward, because, you know, on any given day they want to know that their cash is there, they earned it, they pay tax on it, it's theirs. So why shouldn't they be able to control it effectively? Why should there be a middleman between them and their money? So until the point that the Fed breaks the US economy, and they're doing a really good job, and we've seen some inner workings and rumblings of that in the last couple of weeks, months. I think we're all in the same boat, which is you just need to survive. You just need to, as Raj said, it's just you need to make cash, and you need to conserve that cash. And at some point, when interest rates change and when growth is being promoted by the people that control a lot of this liquidity globally, we'll get back to doing what we do, which is actually picking fundamental stories, helping business owners grow, and ultimately seeing their success through time, you know, on our P&L.
Just a question for you. I mean, do you think the Fed is doing it purposely? I mean, they know that they are breaking the economy on purpose?
The number one enemy globally of democracy is inflation. You know, like you can slow the economy down and put 15% of people out of work, and you've got 15% of your 100% of people that hate you, right? With inflation running at 5, 6, 7, 8%, you've got 90% of your population that hates you. So it's the greater of two evils, effectively. But I think it's more broad than that. You've got a huge war, or I believe we're on our way to war between the West and the East. And China's had a huge funding issue currently. It's had a collapse of its real estate market domestically, and a high US dollar interest rate rips capital out of Eastern markets and back into the Western market, and they need that to re-domicile their supply chains. And so it's political as well as an inflation fight that's going on right now, is in my view. And so, yes, I do believe they want to break this quickly. We lived it in the 70s when they didn't break it quickly, and they were nonchalant about getting inflation under control. And many in this room will know it went for 15 years, and we did get up to double-digit interest rates. I think they're very focused on not having that happen again, and how you do that is you keep hiking until something breaks.
So in just keeping on the macro theme, because I think it's a really good wormhole to go down for the moment. I was listening to a podcast, and they were talking about what unemployment needs to get to, you know, for basically, you know, the sort of slowing down on our economy. Have you guys got any thoughts on, because obviously there's still, you know, unemployment is still quite low. Any thoughts on some of the macro aspects which sort of impact the markets over the next sort of, you know, over the next 12 months? Start with you, Rajiv, looking deep in thought.
We're constantly perplexed by the unemployment numbers. I know so many people that are not working.
Yeah.
So I think the way that it's measured is probably not effective and efficient. This whole WFH,
Yes.
this whole gig economy, there's so many people that are not working, but they're still making money somehow.
And actually, there's articles coming out about talking about people cannot get jobs for 3 months. One guy come out talking about he applied at X amount of 100 of different places, unable to. So yes.
Yeah. So I'll give you an example. We've got a company called Respondent that does surveys. So you can go to companies, and that product goes to big corporates and says you can do a survey about anything, a customer, a product, anything. They have 2.2 million people on their platform, and I would not be surprised if none of them have a full-time job.
Whoa.
But I'm not sure they're captured in the employment or unemployment numbers, right? So I think the way that it's measured is a real problem. We think unemployment is higher than what is reported.
Yeah.
Not only in Australia, but elsewhere as well. But you have all these other factors that are going on which make it's confusing, right? So you've got inflation rising, but you've still got low unemployment reported. We're perplexed.
The other factor, we're at dinner last night, and I could be slightly wrong on these numbers, but one of the people at dinner mentioned that last year, I think it was like where interest rates now, or where basically loans are at, is basically 67% of people's incomes. And at the height of what you were talking about in sort of 1990s, it ended up being 75% of its people's incomes, right? And so you think we're not that far off. Any commentary for you on that, Niv, or some of the macro aspects?
Yeah, I mean, look, you know, when I was at high school, I mean, inflation 2 to 3%. I mean, let's be realistic. Who makes the target rate 2 to 3%? I mean, that's call it 20 years ago, and things have changed. I mean, inflation, look, I just went for breakfast here in Sydney, two of us, $85 for breakfast. I mean, that's unheard of, but, things are expensive. But the keys, the people are still willing to absorb a higher price. So for example, you're still willing to go to breakfast and pay $85. You're still willing
how's
to
that
go
correlation with the willing to pay a higher price and the increase in personal debt, in personal credit?
Yeah. I mean, yeah, people are willing to take more debt and more risks, and as interest rates continue to increase, as Luke's saying, there's going to be a break point. I think we're getting close to that break point, but there will be a turn where there is a break point, and then you'll go in and, the Fed will cut rates, will be more liquidity than ever, QE4, and the next bull run continues.
Okay, now, Luke, you started that chat, so I won't ask you that question because you had really good insights on that. I do want to start, this is a favourite one of mine. One of the things I observed in my own business, and it's one of the conversations it's been having with founders. I'll say the two types of conversations founders are having at the moment, right? And I don't know if you're seeing this in your portfolio companies. One is the challenge with work from home. You mentioned about that. And especially in sort of like dealing Gen Y, sort of millennial, like it's a bit of a challenging area at the moment from how we sort of understood the sort of workplace environment, the future of work, etc. And then you add a technology overlay like sort of generative AI across all sorts of different areas. And, I think all of us can agree if we've ever gone down the wormhole of using generative AI, you can actually increase your output. You can almost do, like, I'll give you an example, right? I'll use a personal example, and I just want to then ask, how does this correlate to the way you see what's going to happen as far as in some of the businesses you've invested in, how more efficient they can get? I'm planning on doing basically post this event, I want to create a program for our clients. We've got some incredible people in our ecosystem, like Friska, like Raj, like Niv, who have built, sold businesses, get behind. I want to make it available for our clients to actually learn from some of these incredible people. And in 2 hours, whilst my son was sleeping, I pretty much used ChatGPT to write the invitation, write the questionnaires, write the forms, pretty much create everything. And I did that whilst he was having his nap, and thought, previously that would have taken someone, an individual, 2 to 3 weeks. I probably wouldn't have made adjustments to it afterwards. And you sit there and think, what does this future of work look like? And so my final question is how do you see the role of some of the innovation and technology, whether it be robotics, whether it be AI, changing some of the, I suppose, efficiencies inside some of the companies, and then how does that impact some of the potential profitability going forward over the next 5 to 10 years? And by the way, also seeing how Meta, Amazon, Google are actually reducing their workforce because it's been so well stated how bloated these companies are.
So at dinner last night, Steve, we're just taking chat with Sergio's here in the room, and he's going to Japan, and he managed to use ChatGPT to find the entire, essentially, hotels, bookings, trains, etc., 12-day itinerary within a matter of minutes. It is just unbelievable. So there will be some industries, whether it's in the travel or newsletter or what you're doing, is going to change it on its head. What's interesting, we actually had a work experience guy that came in, year 10 student last year, and I had a chat to him about how does ChatGPT influence the curriculum for schools, right? And he thinks that'll just be part of the curriculum. He doesn't see it to be replacing, call it teaching, but it's like you'll have to integrate that in the curriculum. It's truly incredible what's about to happen in the next 3 to 5 years.
Yeah, one of the things, this generative AI and Web3 is really important because it speaks to who owns your thought processes in the future. So when you go and add to ChatGPT, it's monitoring not just what you search for, but your logic to get from A to B. And actually what it's trying to regenerate is your thought processes, right? And currently Microsoft is accruing all of those benefits. And so if you think about how you patent something, a new technology, or how you think about crafting your pitch as a broker, for example, or the way you think about your business, they're trying to take your logic and apply it to all these different sectors. And so in Web3, I want you to own that. And Web3 is all about you owning the output of your logic, because you can go and concentrate as much as you want to ChatGPT, but you'll ultimately get your logic to a point where they know what you have and they'll actually outsource you as well. And that's the biggest fear about this whole thing. I think that in the future we should have, and we will, and we do already have, open source AI models that will work for you, that you'll put all your time and effort into training, that'll actually serve you and accrue to you. The value will accrue to you, if that makes sense. So it's something I would think about as you go and put your information and your IP into these places, that it is being harvested and analysed out the back, and it's not for your benefit.
And Rajiv, I'm going to ask you to take a different approach because I know you've got some. How does this impact the future profitability of the companies that you're working with, and also their scalability as well? If you had something else you want to say, please feel free to say it.
So actually, I wanted to make a comment on WFH,
go.
and then I'll come to your
Go.
question, Steve. So on WFH, we're noting across our entire portfolio, the CEOs or the founders or the board are mandating 3 days in. And some people don't like it, but who cares? If they did that a year ago, the market for labor was very tight and it was very expensive. That's changed. And I was saying to both my co-panelists earlier, you know, people that were getting salaries of $230,000, you can buy those same people today for 120, especially in technology, because thousands and thousands of people, and Mr. Spiteri there, who's an ex-Googler, will know all the big brands globally have just cut people. In tech. So I think it's going to be very good for anyone that has capital and money today to hire. On your second point and final one on
Future profitability, efficiency.
I mean, I look at our own business, right? So we use ChatGPT to write about a third of our newsletter and have done that for January and February. That means for us over time, we probably won't need a production or an analyst.
I'll be honest, 90% of the content for Emergence was done on ChatGPT. All in the Christmas holidays.
One thing I would encourage all of you to do that don't use it but should use it, go into ChatGPT and write SWOT for a company. So strengths, weaknesses, opportunities, and threats. BHP, any company, what it writes is extraordinary. It beats anything that any human can write.
Just to give you an idea how founders are using it, we're actually sitting down and basically asking it to write what could our business plan look like, describing our business, makeup of our clients, who we are, and then asking it, say, how would you look at, here's a target we want to achieve, how, and it's crazy some of the answers that it actually comes back at you with. And then you can then input, like, you know, in my case, I input a suggestion about something that we were already doing. And I asked, is this more effective than your strategy? And it come back, yes. And I said, how could I make it even better? And then you get additional answers. And then you can just keep building on layers. So you sit there and go, it's like the ultimate personal coach or the ultimate employee for $20 a month that you never knew you wanted, but is the dream come true. So just we're obviously finished on our time now. Any final comments anyone wants to say? In the final sort of 30 seconds to a minute?
As I said earlier, what I would be looking at, if I had cash, I would look at some listed ASX technology companies that no one cares about, that have strong financials but a bad share price. And if you've got the appetite to wait for 18 months to 2 years, I think you'll do really well in that space.
Thank you. Gurney.
Yeah, I think what Rajiv's saying, just look for value. I mean, inside ownership is really, really important, sort of management track record, strong balance sheets. And yeah, you have to be patient. You know, you have to ride this out.
I would just use this time to research things you're interested in, because I don't think we're going to make a whole lot of money until the Fed pivots. So just be patient, do your diligence, find some good people, some good managers, and just get your cash ready.
Fantastic. Well, gentlemen, thank you very much for your thoughts and your input. Really appreciate it. And obviously for everyone on the stream, I'm sure you enjoyed that, and obviously in person as well. Hopefully you guys sort of stay around to the break so you can ask additional questions during the break. So in the next, thank you very much.
Thank you.
Challenge I've already mentally got. Thanks, guys. Okay, in our next session, we've got an incredible session on, this has been an area which has been passion of mine for some time. You know, we've been working with, we've been working with small and micro caps now since 2009, 2010. And we get the opportunity to work with some incredible companies. We've now seen 10 of our companies we've worked with gone on to become unicorns actually in this space. So as a first step, what I'd love to do is give you some insight, some of the companies we're seeing. Got Mark from Osteopore, and some of the videos that he'll show is absolutely, one of the things I love about working with life science and medical device companies is you can actually see the real impact. You can actually understand the real impact it's going to make in people's lives, and in some cases, the difference it's making already. And Mark, as an example with Osteopore, their sort of presentation. And then after that, I mentioned about EBR Systems, Inc. You know, when I mentioned about my son's heart issue, they got introduced to me via my shareholder, who's a backer of what they're doing. And then the likes of Dimerix, as I said, been following their story now for at least 5 years, and it's amazing some of the different programs that they've got going across. And then Radiopharm and Chimeric, you know, I was introduced to them by Paul Hopper, And Paul said, I've followed Paul now for the last 10 to 12 years, and the media blew him up in sort of 2021 as, you know, the investor that sort of gets behind a lot of life science companies that have gone on to become incredible success stories. But he's someone that I've now followed their career, and said he's one of the companies, Viralytics, that got sold for over $500 million. He was the guy that introduced me to Imugene, you know, when they were at a 30 million market cap. So, you know, that's coming up with Radiopharm and Chimeric, and then likewise with our Arovella. You know, said being able to watch their growth, being able to watch how they've been sort of, you know, basically repositioning themselves on the life science space. So some incredible presentations coming up in this next session. I will let Shella do the introductions. Thank you.
Thank you so much, Steve, and thank you so much to all of the panelists. Please join me to welcome to the stage Mark Leong, Chairman of Osteopore, ASX code OSX.
Thanks. Good day, everyone. My name is Mark. I'm the Chairman of Osteopore. We are a Singapore and Australian medtech company. We do bone and tissue regeneration. We harness the body's own natural bone and tissue regeneration abilities. We are the world's first company to successfully develop and commercialize 3D printed bioresorbable implants. Our implants are the first of its kind. Our proprietary technology allows us to 3D print implants that creates the perfect environment for your bone to regenerate. Our IP micro mimics the structure of bone, and we use a special material that dissolves over time in your body. So what it does is, if you use our implants, it creates the perfect environment for you to grow your own bone through and on the implant whilst the implant dissolves. So at the end, all you have is your own healthy bone, no implant, right? So if you've got a crack on your bone, that's easy to solve. But if you've got a bigger bone fragment loss, say you've got bone cancer, an accident, or a bacterial infection, you need something else to bridge that gap. You could use artificial implants like bones, metals, or plastics, but that gives you a 33% risk of infections. You could use bone grafts, that gives you a risk of 19%. You could use our implants, which gives you a 0.01% risk of infections. It's almost zero. And why is that? Because our implants, our proprietary technology, helps you grow your own bone, and the implant is gone. So what you have is your own natural bone. Our technology is validated. We have regulatory approvals in the US, FDA, Europe CE mark, TGA, and Singapore's HSA. We have done more than 80,000 cases, and we have accumulated revenues about 6 million. We are available for sale in more than 20 countries in every continent. We have patents protecting our IPs, and we have more than 180 papers talking about our technology. Our proprietary technology is 3D printing. It is highly scalable, and we have good margins. We enjoy about 70-80% margins. Let me play you a short video.
First patient to undergo the procedure after contracting a bacterial infection in his leg.
It's eaten through the entire bone pretty much. We're going to have to probably amputate it. And then they said there is an option, the people at the PA are doing something that experimental.
Now, nearly 4 years on, his tibia in his leg has regrown.
Not Not long ago, we would have balked at the idea of 3D printed body parts, but it's no longer science fiction.
Second patient in the world to have a 3D printed implant in her leg to help regrow her own bone. Scaffold for Ash's surgery was printed by Australian Singaporean company Osteopore. The doctors were amazed with Ash's progress. She was able to stand and even navigate stairs weeks before it was expected.
I want to pursue medicine, and I know that because of this. I really, really, really want to. It just seems like every day, watching my scars heal and the changes in my body.
The 28-year-old from Cannon Hill has 20% vision, one leg, a crushed skull. He still thinks he's lucky despite the accident in Vietnam, which should have killed him. Brodie was the first person in the world to have an osteopore implant, which dissolved when his skull regrew.
Being the guinea pig for it has definitely paid off very well.
Brodie wants to represent Australia.
Shoot for the stars.
Or higher.
When John Manwaring lost a jawbone to cancer 2 years ago, he never expected to become part of a world-first medical marvel. The 58-year-old originally had the jawbone rebuilt with bone from his leg, but that disintegrated under further cancer treatment. It's now coming up to nearly a year since he received a second implant, 3D printed by Singapore-based company Osteopore. John, who's been flying into Brisbane for treatment from his home in Rockhampton, says the procedure has made a huge difference to his life.
I can now walk in the shops without anyone staring at me.
So you see that we have done several worlds first, right? Amazing stuff. We want to go beyond worlds first, right? We want to be the standard of care for everybody. We think we can be the most valuable tissue regenerative medtech company out there. And why? Our technology actually makes a difference. We improve patient outcomes. We lower healthcare costs. What's our priorities for 2023? We have got past the worst of COVID. So our revenue needs to grow. That's our ultimate focus as a commercial entity. Our technology can do tons of applications head to toe. We can grow bones, we can grow soft tissues, but we're going to really focus on 3 areas. We're going to focus on the skull, the nose, and the dental. That's organic growth. Inorganically, we're going to look at acquisitions to really turbocharge our revenue growth as well. We've been listed 3 years, and in that 3 years, more than half is COVID. So I think if you look at our quarterly revenues, small numbers, but if you consider COVID really killing momentum, I think we've done pretty well in terms of growing revenues, hitting milestones in regulatory approvals, and opening new markets. Focus number 1, that's the craniofacial. That's cracked skulls. You saw Brodie where we repaired his skull. That's our core application. We have 50% of our revenues on the craniofacial. We have approvals in more than 20 countries. We have had good traction in the US. We got onboarded in several big hospital groups. So we expect some level of traction coming and revenue growth from the cranial market. The next market is the aesthetic market, and we are really super excited about the aesthetic market because we focus on nose jobs, just nose jobs, rhinoplasties. And in just a few years and just in a few Asian markets, it accounts for 40% of our sales. And we are doing really well in Korea, which, if you know Korea, it's the aesthetic market of the world, the capital of the world. We expect this to be a key revenue driver for us. We have done an acquisition recently, and that's our number 1 distributor, our aesthetic distributor. He accounts for 40% of our revenues. This is a sales and earnings accretive acquisition. Through this acquisition, we're going to get 2-3 times more sales value, higher margins. And what's more important is that we get access to the sales team that's going to really penetrate new markets and existing markets for our products. We really think this is going to be the catalyst to really drive huge revenues for us. We are really excited about the aesthetic side of things. Last and not least, it's our dental market. We are looking to sell dental implant-related products. This, we think, is going to be a huge volume seller. We've got approvals in Singapore and in some parts of Southeast Asia. We got a 20 million grant from the Singapore authorities to develop this product a bit better. We expect revenues to come from the dental products in a meaningful way in the next 12 months. So in summary, Osteopore has established pedigree. You've seen the videos, you've seen the technology. It's breakthrough technology that works, right? We do deliver superior results. Ours is a global opportunity, huge addressable markets, and we are de-risked. We've got the tech, we've got the regulatory approvals, we've got sales. And at these prices now, I think it really gives the astute investor a wonderful opportunity. I've come to the end of my prezzo. We have a booth here, so please come over and ask questions. And if you happen to be missing bones, we're happy to help you. Thank you.
Thank you, Mark.
Hello, I'm John McCutcheon, EBR's President and CEO. I'm going to start our presentation with a video news report from Channel 9 News. This report featured one of our patients who received EBR's WISE CRT therapy for heart failure. You'll hear directly from him on the remarkable impact this has had on his quality of life.
A tiny device is giving patients with heart failure real hope when other treatments no longer work. One 70-year-old man says the implant has turned his life around.
This tiny device has been sitting inside Richard's heart for 3 years. It keeps his heart pumping more effectively.
And the only option I had when this trial device came along,
it's literally the size of a grain of rice.
The 70-year-old's heart failure was getting worse after the wires attached to his original pacemaker began to play up.
Eventually, over time, the lead in my left ventricle burned out and they had to abandon it. And so then I had no support for my left ventricle. Within a year or so, I was told I would be bedridden permanently.
This happens frequently. The leads can break or migrate or get infected.
Since 2018, this implant has been trialled in dozens of Australian patients.
There's no lead or wire attached to this. Once it's in the heart, there's very little that can go wrong.
A transmitter under the skin sends ultrasound beams to power the wireless electrode to stimulate the heart. It syncs with technology that paces the other chamber.
The magic of EBR is that we developed the world's smallest leadless pacing technology. Because of its size, WISE is the only leadless pacing technology that can be placed in the left ventricle to treat patients suffering from heart failure. You can see here that all three players in cardiac rhythm management have leadless pacemakers on the market or in clinical studies. Two of them have leadless defibrillators, but no one other than EBR has a leadless solution in development for CRT. WISE utilizes a miniaturized wireless receiver electrode that measures only 9 millimeters long, about the size of a grain of rice. It can be made so small because it's externally powered by ultrasound energy. Electrophysiologists can place the receiver electrode anywhere in the heart, so it's customized to the specific needs of the patient. And it's placed endocardially or inside the heart where the natural conduction system travels. The competitive advantage here is that no other pacing system, lead-based or leadless, can be placed inside the left ventricle. The WISE receiver electrode is so tiny that it gets completely encapsulated by heart tissue within 30 to 45 days, so that it becomes completely inert. Our pivotal trial, Solve CRT, is a two-part study, both of which have completed enrollment. The initial double-blinded randomized phase enrolled 108 patients. The second phase enrolled an additional 75 patients for a total of 183. We've completed follow-up for all of these patients and are now engaged in the full data analysis. The primary efficacy endpoint is the percentage decrease in the left ventricular end systolic volume at 6 months. This is a physiologic measurement of reversing heart failure, and it's measured by an echocardiogram and analyzed by an independent echo core lab. LVESV is an important predictor of patient benefit. It's been shown that a reduction in LVESV leads to reduced mortality and heart failure events. It's the single most important predictor of survival in heart failure patients. It's a key metric for long-term patient benefit. The primary safety endpoint is freedom from type 1 complications versus a performance goal at 6 months. On this slide, we took the results of patients matched to the pivotal study inclusion criteria from available unblinded data and compared them to the established study performance goals. And you can see here that we consistently met the primary endpoints by a sizable margin. We believe this is strong evidence that our study endpoints are de-risked. An abstract has been accepted by the Heart Rhythm Society meeting for presentation at their May conference being held in New Orleans. The Society has an embargo on all data as condition of their acceptance, and will release this data on our ASX platform concurrently with the HRS presentation. Beyond the initial $2.5 billion total available market based on our current indications, we see significant opportunity beyond that as we make further technical advances to expand indications and to move into additional markets. Last year, we announced publication of positive data with regard to left bundle branch pacing. We also announced the 183rd patient enrolled in SOLVE at the end of the second quarter, and we announced the closing of a large growth facility. The next big catalyst will be the release of SOLVE at the Heart Rhythm Society meeting in New Orleans on May 21st. This will be followed by PMA submission towards the end of the year and eventual FDA PMA approval. That will be the beginning of our current commercialization efforts. EBR remains an attractive investment opportunity. There are very few medical device markets with this large of a total addressable market. We're targeting indications for patients who have no other options and therefore have no direct competition. We de-risked the study enrollment, and that could have been a concern during COVID. We've demonstrated excellent clinical success in past studies. We've been granted the Breakthrough Device designation by the FDA, which provides benefit during the PMA review process, as well as reimbursement during early commercialization. The stock price has done well recently, but there remains significant upside as we achieve the catalysts that I mentioned and move into revenue generation. I want to thank you for your time and for your interest in EBR.
Please join me to welcome to the stage Dr. Nina Webster, CEO and Managing Director of Dimerix Limited, ASX code DXB.
Good morning, everybody, and thank you very much for your time today. Very much appreciated. For those who are not familiar with Dimerix, we are an ASX-listed company in biopharmaceutical, working on products in the inflammatory disease space, so predominantly in the kidney disease and respiratory disease. Noting the forward-looking statements. So what I wanted to focus on today was what we call our flagship program. And this is one of the reasons why we think this is a really exciting proposition in this space as an investment opportunity. So we're in what's called a late-stage phase 3 clinical trial. Now, phase 3 means it's the last trial before we go to market. We're in this phase 3 clinical trial globally at the moment, and that has a program that is actively recruiting across 11 different countries globally and is also built-in interim analysis points that the first interim readout is later this year. So from a biotech perspective, it's a really near-term proposition. Because we're in this phase 3 clinical trial at the moment and getting that close to market, we also are in late-stage partnering negotiations at the moment. So we have made this public earlier this week that we do have term sheets on the table. We're in negotiations. So the plan here is we don't take the product to market ourselves. We're a small Aussie company. This is very much a licensing or transaction where we work with the global players in this space who will commercialize the product on our behalf. However, to do that, what we have got is what we call a commercial-ready proposition. So we've done all the pieces of the puzzle. We've completed the manufacturing scale-up. We've completed all of the quality components. We've completed what we call the non-clinical or safety studies. We've also got what's called orphan drug designation. And orphan drug designation means it's a rare disease that we're working in, and it gives us a number of different advantages, which we'll touch on shortly. And it's in a very lucrative market. And again, I will touch on that in just a moment. So when we talk about late-stage opportunity, what we're talking about here is essentially what we consider a significantly de-risked opportunity. And I say de-risked because if you contrast a phase 3 asset versus a phase 1 asset, for example, we've already got a strong safety profile proven in a number of clinical trials we've already conducted. We've already demonstrated efficacy in this compound. We've completed our safety studies, our toxicology studies. We've completed our manufacturing, and we are ready to go to market with that orphan drug designation. So what is orphan drug designation or an orphan disease? And I wanted to touch on this because when we talk about a rare disease, you think, well, that's not very many patients. And you're right. However, this is not an ultra-rare indication. This has a large number of patients, but there's a commercially attractive opportunity here because when you get orphan drug designation, you get a faster pathway to market, first of all. You secondly get what's called orphan drug pricing. So the nearest asset that's working in this space has just announced their pricing in this space, and that is $9,900 per month per patient. So you can imagine compared to standard drugs, again, a very commercially attractive opportunity. It also means we get what's called orphan exclusivity period. And orphan exclusivity means regardless of the patents that we have granted to 2032, we actually also have this exclusivity period of 7 years in the US and 10 years in Europe, where generics cannot enter the market and your patents cannot be challenged. So it's a very, very commercially attractive proposition for partners as well. Just wanted to put that into perspective of another orphan indication you may have seen more recently, and that is a company called Neuren. Neuren actually announced only last week that they've got FDA approval for their orphan disease. And you can see on this trajectory of when they started their phase 3 trial to getting their top-line data, to getting their NDA submission and finally the marketing approval, this very nice traction for going from a $100 million market cap right through to over $1.2 billion market cap in that space of time. So it's a very, very lucrative opportunity as well. So FSGS specifically is the indication we're working in, and it's called focal segmental glomerulosclerosis, and I won't challenge you to say that fast, particularly after a glass of wine. It is a rare type of kidney disease. And it's a rare type of kidney disease that affects children as young as 2 years old as well as adults. It's a really poor prognosis because typically these patients end up with kidney failure within 5 years. There are no treatments approved anywhere in the world. And sadly, those who get a kidney transplant, around 60% get reoccurring FSGS in the transplanted kidney, and nobody knows why. So if they're diagnosed with FSGS, there is a very poor prognosis right now. I mentioned before, this is not an ultra-rare indication. There's over 220,000 diagnosed patients in the 7 major markets at the moment. And if you put that into context of that valuation or the addressable market there, when you've got $9,900 per patient per month, annually that's $120,000 per year per patient with 220,000, it makes it a very, very attractive commercial opportunity. And that is primarily going to be driven in large growth in the coming years by the increased prevalence of FSGS. It is a growing area. It's also got increases in these therapeutic options because there are no approved drugs for this anywhere in the world at the moment, and only 2 in phase 3, and we're one of those. There's an growing elderly population, as well as, of course, the increase in diagnostic tests for kidney disease. So what is DMX-200 specifically? I said it's for kidney disease in FSGS. It is a small molecule and it's given as a single capsule twice daily. So it's a really simple treatment regime. 1 in the morning, 1 in the evening, for the rest of their lives or until their kidney fails. It is a very easy and convenient dosing system, and I mentioned before we have this really strong safety profile as well as the proven efficacy in our prior phase 2 studies. So this is the phase 3 clinical trial that we're working on at the moment. We are currently recruiting in 11 different countries. The trial overall is 286 patients over 2 years. However, because we have this orphan drug designation, we've built in these 2 interim analysis points. The first one, part 1, the interim analysis is due at the end of this year. Again, a very near-term outcome for a phase 3 clinical trial. The part 2 continues straight into that after the first 72 patients with 144. So it's only additional 72 on top of the first 72 we've already got. That then gives us a second interim outcome. If that data is looking very promising and compelling, we could go to market at that point. So we could take that for what we call accelerated approval. It's the advantage of an orphan drug designation. You can get the accelerated approval. And in the background of that, the study continues for the full 2 years. So there's a real opportunity here to go to market halfway through the study. So I just wanted to sort of end up where I started, and that is why, again, we are a very compelling opportunity in this space. Phase 3 asset, much lower risk than a phase 1 or phase 2 asset with proven safety, proven efficacy in a phase 3 clinical trial across all of the geographic regions right now, including US, Latin America, Europe, UK, Australasia, and Asian territories as well. We're in advanced partnering negotiations, working with potential partners who would take this to market on our behalf, as well as completing all of that clinical trial component because we have a commercial-ready product with manufacturing already built up for commercial scale. The orphan drug designation gives us those huge benefits of the orphan drug pricing, exclusivity, and opportunity for getting to market faster on that pathway, with a growing market that's expected to grow at 21% per annum. So on that, I'm just going to pause and say thank you very much for your time today. We do have a booth today, and I welcome any questions you might have later on. Thank you.
Hi, I'm Jennifer Chow, CEO of Chimeric Therapeutics. Thank you so much for letting me introduce Chimeric to
Hello, everybody, and thanks for joining Emergence 2023. My name is Riccardo Canevari. I'm the CEO of Radiopharm Theranostics. So Radiopharm Theranostics is a startup company that has a core business in radiopharmaceutical, imaging, and therapeutics. What are radiopharmaceutical? This is an emerging class in oncology where you have a very selective molecule that is able to image where the cancer cells are. It's like a very potent torch that is able to find the cancer cell. And then what you do on the same molecule, you change isotope, you put an high energy isotope, and the molecule goes where the cancer cells are and are able to disrupt and kill the cancer cell. So these technologies has been proven because there are 2 products approved by FDA. And Radiopharm Theranostics is entering the space with an important pipeline. We do have 6 platforms because we really like to address different disease areas in solid tumors. We do have our Pivalate, that is an imaging agent for brain metastasis. We have Trivaexin, is a peptide for pancreatic cancer. We also have molecule for breast and lung cancer. And we licensed two monoclonal antibody able to target prostate cancer and a rare indication where there is a very strong unmet medical need, like osteosarcoma. Finally, we have another molecule, is a peptide for brain tumors. So as we are a small company and we cannot do all together, and we want to be sure we have the right priorities and also we invest the money in a very accurate way, we decide to focus first on our three priorities for 2023. Pivalate for brain metastasis. This is our most advanced technology. We reported phase 2 data, positive phase 2 data in October 2022. And now we are engaging with FDA to have the permission to start a phase 2B, phase 3 pivotal trial. That will be, of course, great to be in the clinics for a phase 3. Our second priority is a second imaging agent, and this is for pancreatic cancer, an area of very high unmet medical need. And the third priority is our first therapeutic trial. It is going to be a phase 1, and it is planned to be in Australia, and is going to target patients with non-small cell lung cancer. So Pivalate, again, is our most advanced technology, is a very large patient population, about 300,000 new patients every year only in US. And speaking with physicians, they really see a strong need for a PET agent that is able to detect as soon as possible brain metastasis. The second priority is our molecule for pancreatic cancer is also extremely important because we have the imaging and we have the therapeutic agent. So here is exactly the case where we can try to see where the cancer cells are and then try to destroy them with our therapeutic agent. We plan to start this trial in the next couple of months because we have already received FDA IND approval the last week of December. We are very positive about this molecule because we have performed an investigator-initiated trial where we were able to show superiority of our imaging agent versus the current standard of care. And I mentioned our trial in Australia for in non-small cell lung cancer. This is going to be a single domain monoclonal antibody targeting PD-L1 expression. And this trial will start soon as we expect to engage with the ethics committee in the next few weeks. So excited about the journey of the company. Our first three priority is what you can see on the top. But as soon as we have the operation in place, we do have additional trial, all therapeutic molecule in different solid tumor types that we plan to start in the months to come. Breast, prostate, osteosarcoma, glioblastoma, or very interesting area. So we are excited about the journey. We plan to have a significant number of news to the market in the next month. And in particular, we believe that 2023 can be a transformative year for Radiopharm Theranostics. We consider a high probability of two inflection points, one more around Q2 and one more at the end of the year, where our clinical development is really delivering important milestones. And with this, I really like to thank you for listening to the Radiopharm Theranostic story, and I wish you a very good rest of the event. Thank you.
Hi, I'm Jennifer Chow, CEO of Chimeric Therapeutics. Thank you so much for letting me introduce Chimeric to you today. A quick disclaimer. Chimeric Therapeutics is a clinical stage cell therapy company listed on the ASX under the symbol CHM. Our share price currently is about 7 cents, with a range between 6.5 cents to about 16 cents over the course of the last 52 weeks, and a market cap of about $30 million. Our focus at Chimeric is all about bringing the promise of cell therapy to life for more patients with cancer. And what that really comes from is our experience. Cell therapies have actually now proven that they have the ability to cure patients with cancer. And you see some of the patients that actually have received cell therapies and are now 10 years out, cancer-free. So our goal is really to be able to bring these outcomes to more patients. Not surprisingly, when you see that we can cure cancer and have outcomes like this, cell therapy is anticipated to be the fastest growing market segment in oncology in the next 5 years, growing from about $10 billion through to about $42 billion over the course of those 5 years. At Chimeric, we're really focused on cell therapies, and we have 3 strategic pillars around which we've built the company. The first and foremost is to have innovative assets, first-in-class assets, as well as best-in-class assets. And we make sure that all of our assets have robust IP around them. We then have a team of people that have the cell therapy expertise and experience that are required to be able to drive these assets from early stage development through to the patients that need them the most. And we do that by focusing on what we refer to as commercially conscious development. And this really is all about keeping the patient that needs the therapy in mind and looking for the most straightforward path from early stages of development through to commercialization. And with our assets, you can see highlighted here, we've already had some very positive signals in the clinic and are looking at some milestones that are coming up in the next 18 months that are also focused on our clinical outcomes. So I'll give you a very brief introduction of our assets and where we are. Our assets are actually CAR T cell therapies or NK cell therapies, and that's just really about the type of cell that's being used. On the left-hand side, you see 1101, CHM 1101, which we licensed in from City of Hope, and CHM 2101, which we licensed in from the University of Pennsylvania. And on the right-hand side, you see our NK platform, CHM 0201, which we licensed from Case Western. CHM 1101 is actually currently in a phase 1A clinical trial that's targeting glioblastoma. And this particular asset was very much designed for efficacy. What we've seen to date in the phase 1 clinical trial is no dose-limiting toxicities. We've seen about 70% of the patients have disease control, and we've seen that disease control last already for up to 3.5 months. Now, this is a 4-dose level trial. We've already completed 3 of those dose levels and are now actually treating patients in the 4th and final dose level. So we're excited to be able to see the data from this clinical trial, the complete data set, by the end of this year. 0201 is our NK platform, and this is a technology that can make multiple additional new assets. It can be used across both solid tumors and blood cancers, and here we've also seen some incredibly encouraging phase 1 results to date. This highlights that phase 1 clinical trial that's been completed and published. We saw, importantly, safety for the patients in the trial, persistence and expansion of the cells, and efficacy both in solid tumors, colorectal cancer patients, and in blood cancers, acute myeloid leukemia patients. And you see those numbers, 33% or a third of the colorectal cancer patients responding to the therapy, and 100% of the blood cancer patients responding. What you see highlighted on the right is a really exciting case study of one of the patients that was in this trial that now is 2 years out from her treatment and remains completely cancer-free. So very exciting, this initial data. And this initial data actually had us move to put this asset in combination with another asset called Vactisertib and open a new clinical trial at the end of last year with our first patient dosed in January of this year. So we're very excited to move this trial forward, complete recruitment of this trial this year, and look for this initial data set in 2024. The last piece to our pipeline is CHM-2101, and this is from the University of Pennsylvania and was highlighted in the Nature Cancer publication. The efficacy that we saw in preclinical models showed complete eradication of all tumor cells across 7 different types of cancer with safety. This particular asset we're moving into clinic, and we're very excited to see what it will do for patients with gastrointestinal cancers. Across the pipeline, you can see we have the ability to address unmet needs across a number of different tumor types and certainly really improve survival for the patients that need it the most and move into very significant commercial opportunities with the approval of these assets. The Chimeric team has the experience and expertise, as I mentioned, to be able to take these assets and move them from preclinical early stages through to commercialization. The team is small, but comes from the top cell therapy companies in the world and have proven their abilities in taking 4 of the 6 approved CAR T cell therapies from preclinical development through to commercialization. Over the course of the next 18 months, we've set ourselves a number of milestones, some of which we've already started to achieve in 2023, and all of the rest really being focused on clinical outcomes for patients, looking at the early and initial data for all of our clinical trials. So with that, Chimeric brings an innovative and diversified pipeline with first and best-in-class cell therapies. These assets have already begun to show early clinical promise in both AML as well as in glioblastoma. We have a team that is able to optimize development of these assets to be able to move them forward through development to the patients that need them the most, and believe we certainly offer the potential for realization with near-term catalysts over the course of the next 12 to 24 months. With that, I thank you very much for letting me introduce Chimeric to you, and certainly encourage you to contact me if you have any questions. Thank you.
MD of Arovella Therapeutics, ASX code ALA.
Good morning. Great to have you all in the room. Thank you all very much for joining and taking the time to listen in today. And thank you very much to the organisers at Wholesale Investor for putting on the event. I'm delighted to talk to you today about Arovella Therapeutics. We are a biotechnology company focused on cell therapy, as we just heard from Chimeric Therapeutics, which is a nice introduction. We are listed on the Australian Stock Exchange under the ticker ALA, and I'm certainly looking forward to taking you through our invariant natural killer T-cell platform. I will be making forward-looking statements, so please take note of our disclaimer. Now, Jen introduced nicely, and I can see there's common overlap in some of the imagery here, where why we're so excited about cell therapies in terms of cancer treatment is because of what she just mentioned, that patients that are taking these therapies experimentally 10 years ago are still cancer-free, which is why we're using the word cure and cancer in the same sentence, which is a lovely place to be. Now, over that time period, what we've also seen since approval of the 2 leading therapies, Yescarta and Kymriah, one's done over $1 billion in sales, the other over 500 million, and another therapy approved in 2021, in 2022 did sales of just under 500 million. So it is set to be a very important pillar of oncology treatment, and of course, a very big market, as Jen alluded to earlier. However, we do see that there is a really important need for a different approach to these types of therapies, because the current therapies, T cells, they must come from the patient. Okay, so we take the starting material from the patient, genetically modify that material so it then ends up being infused back into that individual. So that costs about $500,000 US per dose, which is quite cost prohibitive. Logistically, it's very challenging, and so it sets the scene to have a very high bar. So what we're actually working with, it's an invariant natural killer T cell. We will be able to take the therapy from what we call a healthy donor. We make the therapy and then we can freeze the therapy, and I'll talk more about that in a moment. Another challenge when you're making the therapy is what we would say just in time, is that you have a number of weeks before the patients can get access to that therapy, which means that some that have aggressive disease may succumb to the cancer before the therapy can be produced before administration. So our iNKT cells, we do believe are set to solve some of those logistical challenges, but we also think for the data that we've generated to date may have advantages in terms of efficacy. So this is how we would start. Instead of having the therapy produced from a patient, we start with that healthy donor. The way these therapies work is we actually isolate human immune cells. We then genetically reprogram them to produce something that's called a chimeric antigen receptor, or CAR, but I'd like you to think about it as a guided heat-seeking missile that will find, recognize, and trigger destruction of cancer cells. They get grown up into the billions, and in our case, vialed and stored in the freezer, where they can be pulled out and immediately used for administration. So the advantages of this are that we have healthier starting material, because these cells will not have seen cancer. They won't have seen chemotherapy or radiotherapy, so we think they might be more efficacious. We also know that it will be scalable. We'll have hopefully hundreds, if not thousands, of doses per batch, not N=1, which is very, very cost prohibitive. We know that we will be able to get patients access to the therapies faster because we don't have that manufacturing step. And it also removes the risk of manufacturing run failure. Once it's in the freezer, we know that that therapy is ready, available for use. So in terms of our particular targets, we've got three major pipeline candidates at the moment. ALA-101, we're developing for what we call CD19 expressing lymphomas. And so this is a common malignancy that's now across a range of blood cancers, and that's our lead program, and it's our most advanced program to date, which we're hoping to advance quite soon into the clinic. So we also are combining that therapy with another well-known biotechnology company called Immugene in Australia. They have an oncolytic virus platform, and we combine the two therapies together. And what we hope that will enable us to do is actually target a range of different solid tumours, which opens up an enormous market, given that solid tumours do account for about 90% of cancer diagnoses. And on the very right-hand side, we have our third program. It's called ALA-104. It targets something else that's found on the surface of cancer cells through what we call, as I said, mentioned earlier, a different CAR. We're expecting that will have promising activity against blood cancers like multiple myeloma and also a number of solid tumours. So an important feature of our platform is that we expect that we can continue to expand and evolve the pipeline by switching out those guided missiles and adding new CARs to target a range of different cancers, including both blood cancers and solid tumours. So in terms of the pipeline, we do have quite a busy, we've had a busy start to the year, and we'll have a busy 2023 ahead of us. For our lead program, as I mentioned, it's called ALA-101, which is targeting CD19 producing blood cancers. We are currently in the stages of optimizing and scaling up the manufacturing. Once that's been completed, we can submit the necessary documentation to regulators to commence phase 1 clinical trials and get these therapies into the hands of patients. For ALA-101 plus the oncolytic virus in partnership with Immugene, we're currently working through some proof of concept studies. We saw promising in vitro work already, so we're moving to what we call in vivo or animal models to take that a step further. And for ALA-104, we're currently working through target validation and also working to combine that with our iNKT cell platform to demonstrate proof of concept. So in terms of a biotechnology company, what's really important equally behind the technologies is the team. So we've worked very hard over the last 18 months to assemble a really purpose-driven team. So we have a phenomenal amount of experience across cell therapies. I'm not sure why Minnie's there twice, but she certainly does seems like she works 200%. But certainly a wonderful team dedicated to drug development, in particular cell therapies. We do have representation across Australia, but also the US, because we know that that's where a lot of the talent lies for these particular types of therapies. And only last week, we're delighted that we've appointed Dr. Tom Duthie as our new chair of the board. He's got a wonderful amount of experience, and he was formerly the head of investor relations and corporate development at a company called Certex, which was acquired for $1.9 billion in 2018. So delighted to have him join as our chair. So in terms of the company, we're currently capitalized at about 25 million, but over the course of this year, we completed a placement early in the year at 2 cents, and we're now back at 3.5. So we do expect that we've got good results coming up throughout the course of the year. So we're looking for some value accretion from that perspective. And we do have some excellent shareholders on the register. Merchant Group is our largest shareholder, so they've had a lot of experience across the biotech sector. And we do also have a number of good, supportive, high net worths and small institutional investors on the register as well. But certainly looking to welcome additional investors to the Arovella register that also understand the potential rewards that can come with an investment into biotech as well as the risks. And with that, I'd just like to say thank you very much for your attention, and please come over and see us at the booth. We'd be delighted to take you through the story in more detail. Thank you.
Thank you, Michael. We'll be back shortly.
Good afternoon, everyone. I'm going to talk about the grid battery of the future. So the lithium-ion battery, as you know, is a fantastic battery, but it has some challenges. And the first challenge is obviously fire and explosion. This is called thermal runaway. And in a lithium-ion battery, it's virtually impossible to put out the fire, because if you douse the fire, a normal fire would just go out because you take oxygen away. What a lot of people don't realize is that you actually generate oxygen at the cathode end of the battery, so virtually it's impossible to put out. The other thing is that lithium-ion batteries have very limited temperature ranges, so they only operate between 15 to 35 degrees. So in the very cold, the battery actually slows down. That's one of the other challenges. And the third challenge is that the life of the battery is generally about 8 to 10 years. And then the final challenge is the critical metals concerns. So you've seen the price of lithium go up 5-fold in the last 18 months. This is a concern for the industry. The other concern is the cobalt supply. Ethical concerns, because 70% of cobalt comes from the DRC, and we know about child labour and labour issues in the DRC. So this is a concern for the battery industry. The other concern is that 90% of graphite comes from one country, China. So can you imagine all the supply of lithium batteries coming from one country, which is a geopolitical risk. Finally, the copper crunch. There's research that shows there's not enough copper mines being developed to service just the EV forecasts. And then also, finally, manganese. So my question to you, is there a battery that can actually, is fireproof, can operate in a large temperature range, has more than 15 years life, no lithium, no cobalt, no copper, no graphite, no manganese? So this is our Serenergy battery. Essentially, it's a salt and nickel powder battery developed by the Fraunhofer Institute of Germany, the Battery Institute, and we have a joint venture where we own 15% of the 75% of the project to commercialize this technology. So essentially, you can see there, the main ingredient is actually salt. So what does this battery look like? One of the benefits of the battery is that, as I said, it's totally fireproof. The life is beyond 15 years. It operates down to very cold temperatures because in the battery it operates at 270 degrees. It's fully insulated and it's a bit like a mammal. It can operate in very cold climates as well as hot environments. The cycle life is beyond 15 years. And the best thing about it is it uses sodium ions. Sodium ions is very reactive. It's just under lithium in the periodic table. And it's totally cobalt-free as well as the copper and graphite-free. So how does the battery work? So let me show you. This is solid-state technology. So we have a ceramic tube. And essentially, all lithium batteries are trying to get a solid state where there's no liquid electrolyte. So all you're doing is you're adding salt to it, add some nickel metal powder, you insert a positive electrode through there, and then you put it into a cylinder which acts as the negative terminal. So essentially that's what the battery looks like, and that's the finished part of the battery. 240 watts, 240 of those forms a 60 kilowatt battery. So some of the graphics, there you go, that's the ceramic. You've got a positive electrode in the middle. We fill it up with salt crystals and nickel metal powder, and then we flood it with a alumina chloride solution, and that sits in a casing, and that essentially is the battery. So from a chemistry point of view, how does it work? Well, essentially, when you charge the battery, the sodium ions migrate through the ceramic piece, which is the electrolyte, and it forms molten sodium on the other side. And when you discharge the battery, the sodium goes back, grabs the chloride, and becomes salt again. So that's the process. Very neat technology. Essentially, we didn't develop it. It was developed by the German Institute. They were looking for a partner to commercialize it, a partner that had land in Germany, and we fitted that criteria. We got a battery background and we got an alumina background. The ceramic part is the alumina battery. So the unique part of this battery is a self-forming anode. It forms the anode when you charge it and it discharges it. Very neat technology. Well, how does it compare to other batteries? It's very similar to the lithium iron phosphate battery. Very dense, produces a lot of power like the lithium iron phosphate. Very safe, very low maintenance. It hasn't got any moving parts. Unlike lithium ion batteries, you've got fans, and this is actually fits in right into the grid storage market. So the market we're targeting is the grid storage market. This is the market you want to look at. Everybody's focusing on EVs. This is like the lithium industry 12 years ago. Everybody is looking at how do you take the sun's energy and shift it to the nighttime. I'm sure a lot of people have solar panels today in their house. You're generating electricity for 0 cents into the grid and you're buying it back at night at 50 cents on a kilowatt hour. Okay, so how can we shift that to the nighttime? This is some visuals of the pilot plant that was built. So Fraunhofer spent 35 million euros in the development of 8 years, and this is a shot of some of the operating pilot plants. So these batteries have been produced. You can see the yellow version is a 5 kilowatt version undergoing tests. So it's not a research and development idea. It's already been produced. It operates well. We need to take it to commercialization. So our project is a 100 megawatt plant in Saxony, Germany. As you can see, some of the ceramics been made. We are completing a DFS to build this 100 megawatt plant in Germany, and then we look at gigawatts beyond that. Where are we in Germany? We're on the border between Poland and Germany, in the east part of Germany, in Saxony. We already have the land there, and we're developing this project there. So very exciting technology, and they quote that it'll be 40% cheaper than a lithium-ion battery. Well, it makes sense. You don't have any lithium in the battery, you don't have any cobalt, you don't have any copper, you don't have any graphite, and you don't have any manganese. It's just salt and nickel metal powder. So this is the first product we launched. It's a 60 kilowatt pack running at 100 amps and 600 volts. We got so much interest saying, can we have it in the house? Essentially, these cylinders are sitting in a rack. They pull out. There's 240 of these cylinders providing 60 kilowatt power. So the market really is in the industry. So that's our vision. This is the new technology in grid storage. Thank you.
Please join me to welcome to the stage Chris Noon, CEO of Carly Car Subscription, ASX code CL8.
Thank you. Good morning, everyone. So I'm Chris Noon, CEO of Carly Car Subscription. We are a listed business that is focusing on the car subscription opportunity. If you haven't heard of car subscription, a car subscription is an alternative to leasing or buying a vehicle. It's for people who would normally purchase a vehicle or finance it, but they need more flexibility. Our average retention period is 5.4 months, to give you an idea of where it fits in the market. So the best way to explain our product is to hear from one of our customers.
My previous car was unfortunately recalled, so I was left without a car, but I still really needed a reliable option to get from A to B. I didn't go and buy a new car because during the time of COVID, I didn't know what was happening with my job. I felt so anxious potentially not having my job and having no car. I didn't want to be locked down to any commitments. I first heard about Carly through a friend, and I'd never heard of anything like it before. Carly is a car subscription company which allows anyone to have access to a car on a month-to-month basis, and you can cancel whenever you like. Carly's been so good. I didn't have to think about getting out a loan, I didn't have to think about insurance, they had everything covered for me. I just jumped onto the website to see what car was best for me, and everyone who I dealt with was really, really happy to help me. I think the most convenient thing about Carly is that there's no hidden costs. You can cancel whenever you like. You don't have to put a deposit down. It's really, really simple. Carly has been great. It's taken away the anxiety of thinking about having to buy a car. I've honestly really, really enjoyed my experience with it. 100% I'd recommend Carly for anyone.
Thanks, Sophia. So we're a business that's operating in the automotive industry, providing an alternative for people who would normally purchase or lease a vehicle. We're the only ASX listed company focusing on this opportunity, and we've got some very large auto industry players as our shareholders. SG Fleet, the largest fleet management and leasing company in Australia, saw an opportunity to work with us to offer shorter term products for their individual business and government clients. Also, Turners Automotive is the biggest seller of cars in New Zealand. We power their subscription business through our software platform. The CEOs of both these businesses sit on our board. The research we've done shows that there's a lot of interest in car subscription. 38% of all Australians are interested in car subscription, and that increases to 69% for Gen Z. The best way to look at car subscription is what it's not. It is not car share, which is 1 hour to 1 day. We're not the boring, old, traditional, really expensive car rental product, which is 1 to 14 days. Our average period is 5.4 months. So we've established a really good niche between rental and outright purchase of a vehicle. We've been kicking some goals recently. 69% increase in revenue in the last half results, 261% increase in gross profit. We've been decreasing the cash used in the business, massive decrease of 80% in customer acquisition costs. We're really utilising our vehicle fleet well, 87% utilisation of the fleet. We're interested in cars that make money for us, not cars that sit in a garage. And we've grown our fleet by 158%. We've been growing ever since launch in March 2019, and we grew every quarter through COVID as well. So even when people were locked out, we were increasing our subscribers. The great thing that's happening in our business is that our revenue as a proportion of our overall cash receipts is increasing, and that is because we are taking greater ownership of our fleet of vehicles. And you might be wondering why our share price has gone up by 30% this week. That's because on Wednesday, we announced a $10 million asset finance facility. This is a real game changer for our business. It will allow us to quadruple the size of our current fleet of vehicles. And if utilised at 87%, which is our consistent achievement, that would be generating 4.7 million of revenue per annum. So this is just the start for us. We're looking for further asset finance facilities so that we can continue to grow the business. We act as a marketplace between supply and demand. On the demand side, we have consumers and businesses. On the supply side, we have our own fleet of vehicles. We also operate an asset-light fleet of vehicles, and this is where we partner with manufacturers, dealers, and also fleet management companies to monetize their vehicles on their behalf. So some of the vehicles sit on our balance sheet. We make very high margin from them. Other vehicles sit on someone else's balance sheet. We make a slightly lower margin, but it gives us a lot more flexibility. What we're focusing on at the moment with the current supply restrictions in the market is the asset heavy. Money talks. We can go out there and buy the cars and get them delivered quickly. And that's what this asset finance announcement is all about. Let's look at the use cases for our customers. These are customers who want a car, they want to drive it most days of the week, but they want flexibility. They don't know what's happening in 12 months. They don't want to buy a car now because they might have the wrong car in 6 or 12 months. Might be expecting to start a family. They might be scared about unemployment. They might just have a short-term contract for use of a car. And that flexibility also carries over to corporate and government clients as well. Short-term projects, seasonal sales teams, are all great reasons why people would choose a car subscription. As I said, the interest in car subscription is higher in the younger generations, but at the moment, most of our business comes from millennials and also Gen X. We've also got a fairly decent business from the older generations. We're a purely online business, and we still have the older generations taking our vehicles because they really see the advantages of the flexibility. The great thing about the strong interest in younger generations is most of these people are not yet 21. So every year, a very large cohort of people will be turning 21 and will be falling into our target market. We see a big opportunity for electric vehicles, and we've been fortunate to be working with Hyundai. We receive vehicles from Hyundai. We don't pay a cent. We just pay a daily fee for the use of those vehicles when they're subscribed. They're provided on an asset-light basis. And we've even got the sold-out Ioniq 5, which you cannot buy in Australia. You can only subscribe to those in Australia if you missed out. We have a number of strategic relationships. Our second largest shareholder is SG Fleet, the biggest fleet management and leasing company in Australia. Third largest shareholder is Turners Automotive, the biggest seller of cars. Both of these companies have seen the opportunities with car subscription and how they can help to grow their overall business. But they also saw that it wasn't an area they could do themselves. They needed a strong partner like Carly. We've also partnered with Hyundai to be their subscription partner in Australia as well. We have an exclusive product ruling for car subscription. This only applies to Carly. So any business or individual that's wanting to claim a tax deduction or understand fringe benefits tax can rely on this product ruling to have certainty about how to treat tax deductions and fringe benefits. We have some very experienced directors and management on our board from very large automotive companies. So we're coming into this market, very good knowledge of the industry. And to finalise, why would you invest in Carly? Well, it's pretty simple. Just go to your stockbroker. The code is CL8. Three main reasons. We've got a proven business model. This is not a blue sky idea. It's not a theory. We're showing quarter after quarter that we are delivering results. We know the pathway to profitability is asset finance. We have just secured our asset finance, $10 million, and we're looking for more to grow our fleet even higher. And the asset finance is something that we've proven before that when we've secured it, we can get the cars on the road very quickly and generating money. Thank you very much for your time.
Thank you. Please join me to welcome to the stage Justin Hills, founder and CEO of Camplify Holdings Limited, ASX code CHL.
Thank you. So Camplify is on a vision to become one of the world's largest RV rental sharing platforms. We're currently in a number of countries, the biggest in Australia, New Zealand. We've been in the UK for a number of years, in Spain, and we've recently launched through acquisition in Germany, Austria, and the Netherlands. So Camplify is a platform that connects RV owners and people who want to rent a vehicle. We provide everything that those two parties need to be able to connect and transact, including managing bonds, taking payments, providing insurance, providing roadside assistance. So essentially those two parties can't really exist and transact without us. We have a platform that has extremely low leakage. In many cases, a lot of our customers who just want to extend for one day actually come back and put that day extension through our platform because we provide all of their insurance and all their cover. Generally speaking, when you've got a vehicle that's worth upwards of $70,000, you don't really want to let that out to somebody when you don't have the right cover, insurance, contracts and support. And so we provide all that to our customers. So recently we acquired a company in Europe called Paul Camper. So we now operate 2 brands globally, Camplify in the existing countries we're in, and now Paul Camper in Germany, Netherlands and Austria. So Paul Camper has existed since 2013. They're the largest rental platform, very similar to us in the European market. And so now we're in a position that we're the largest operator in this class in sort of both sides of the globe, and certainly have a very, very good engaged long-term customer base. So over the last few years, we've been growing our revenue, our GMV. Our GMV has grown at an average of 81% CAGR over the last few years. Our revenue's grown at 96% CAGR over the last few years. And our gross margin has been increasing over the last period in terms of our core rental platform. And as a percentage, as we add in our additional products, we're seeing some good increases over the last half. So what I wanted to talk to you about is what we're seeing in the market. So if we look at our H1 FY22 results, we saw that we had future bookings. That's bookings that customers have paid for but have not yet transacted through the platform of 8.4 million. Just in this recent period, we've seen that grow to 31.2 million. So they're bookings that will generally take place in the next 12 months, majority of them within a 6-month period. So we're seeing a huge increase in consumer confidence. We're seeing customers booking further in advance, and we're seeing customers booking higher value, more long-term bookings on our platform. So, we've seen that that's grown by 270% in that period. And we see that, combined with the growth path that we're already on and this support for consumers in those markets, then it means that we're seeing really good support for the company and really strong interest in this space. And that's been driven by a couple of key things. Firstly is that we generally provide low-cost holidays. So our average holiday is around $1,700. And when you can compare that for consumers who the majority of our customers are families looking to provide a low-cost holiday in a more challenging economic environment, we're a great outcome for them. We've also seen some of our markets really see a great return of international tourism. So New Zealand, for example, we've seen a huge increase in activity in that market since border restrictions lifted last year. Things are a lot easier to travel more internationally. And so that market has seen a massive increase of over 1,300% in that period. So we're seeing longer term bookings, we're seeing more bookings, and we're seeing more higher value bookings with better consumer confidence overall across our markets. As mentioned, we recently acquired this business in Europe. So from a calendar year perspective, that provides us with a run rate GTV of 132 million. So we've now got a combined fleet of over 25,000 vehicles that actively rent through our platform. Our overall take rate as a percentage sits at roughly about 26%. We've seen that the Paul Camper business has traditionally operated at about 18%, and Camplify has traditionally operated at about 26% take rate. So we have a lot of additional revenue products that we provide to our customers, a lot of different membership levels, insurance levels, and additional products that our customers use for on-platform performance and off-platform performance. So our intention is to migrate this business over to our platform over the next 6 months and to start to get some of those revenue products into that business and start to increase their take rate over time through these additional products. Great news is when we introduced that team from Paul Camper to these products and started to look at how are these going to operate in the European market, they were extremely positive about the fact that a lot of their customers have actually been asking them for those similar things for a long time. So we've got them ready to go. They're integrated into our platform already. And as we start to migrate that business across to our platform, then that provides a great opportunity for us to increase their take rate and help that business to continue to grow as well. We've also already done this process once before. We acquired a business, 2 businesses in New Zealand last year. Those businesses we acquired for script at a valuation of about $5 million. We've dramatically increased their performance in that market, and we've completed their migration and reduce some of their costs as well. So we've done this successfully. We've got a great team to execute on it. This will really, at the moment, we sit as one of the world's leaders in this, one of the biggest in the world, and really in a dominant position in those two market segments. So in Australia, we see there's 12.6 million camping trips taken annually. It's a massive market here in Australia. The RV sector in that, of people who actually have access to an RV and use it, is only a very small percentage of the people that actually participate in this sector. So our idea is to unlock those vehicles for people to have access to on demand when they want to use them from their local neighbourhood Camplify representative. So there's about 800,000 vehicles in the Australian market. Right now in Australia, we have about 10,000. So we have a huge opportunity to continue that growth on the platform and continue a lot more of those vehicles to be able to be unlocked, to have access for these people who want to trade up from a tent. Looking at the European market, there's a massive opportunity to continue the growth there. We've got a great team, a great platform, and a great ability to grow in that market. There's roughly about 5.6 million privately owned RVs in that market, and less than 0.4% of those are actually listed on a rental platform available for rent right now. So we have a huge opportunity to continue that and see that grow. All of our tech is built in-house. It's all built here in Australia, and we have a great access to engineers to be able to help us execute on that. So we're a really, truly global marketplace. We're highly scalable. Our unit economics are really very attractive. Customer acquisition costs are excellent, and our return that we get on a per bookings basis is really positive. We're cash flow positive. We've got a lot of cash on the balance sheet, and we're in a position to really take advantage of this current market. Thank you.
Please join me to welcome to the stage Duncan Anderson, CTO and President North America of Openn Negotiation Ltd, ASX code OPN.
Thank you. Can you hear me? Right, I'm not going to go through every slide that's on the deck. It is downloadable on the ASX platform. I'll walk through a description of the Openn product, who we are, and then really talk to you about the big opportunity in front of us right now, which is our entry into the North American market, because from there we've got a very clear pathway to scale and revenue at scale. I think that's what people would be most interested in. So who is Openn? What does Openn do? Openn is a digital offer management platform. It is designed for real estate agents to manage the offers that come through, multiple offers that come through on a property. So it operates in the private offer space, or the private sales space, offer and acceptance, you might know it as. But it's kind of akin to an auction platform in that the solution provides transparency to consumers over the process. So why is that important? If you're from a non-auction state, you would probably know that going through the offer and acceptance process is a bit daunting. It's opaque. If you're a buyer and you walk into a real estate agent, the real estate agent might say, I've got 3 offers over here. Can't tell you what they are. Put your best foot forward. At that particular juncture, you've got really no information about the market. You don't know what price you need to pay. You don't even know there really are 3 offers out there. And that creates a series of distrust. And it creates an imperfect market. The problem with an auction in the states that don't use it, the reason they're uncomfortable with it, is people don't like to be out there in public in a backyard putting their hand up to place a bid. It's uncomfortable for those not used to it. And so Openn was invented to essentially solve that problem, provide a platform where people can discreetly place their offer, but transparently see what is going on. We started in Perth in 2017. We grew to service every state across Australia. It's been a great success story in Australia, but the real very interesting pathway we have now is an entry into the North American market. We'll explain that in more detail. One very interesting output from the product is because we are capturing every single offer that goes through a property process, we're capturing it automatically and we're capturing it in real time. We're developing a set of data that is unique in this space. We call it the depth of market data. The depth of market data is providing analytics that the finance industry in particular is very, very interested in because it has the ability to develop lead indicators that simply don't exist today. So for instance, we know in January there might be a median price of 700,000. In June, it might still be 700,000. You might think the market is stable. But if in January you had 6 buyers within a standard deviation of 1 point from the mean, but in June that's dropped to 3, you know there's an underlying move in the market that can predict forward where prices might move. So the underlying depth of market analytics is a massive opportunity for us. I'll come and explain that a little bit later in the North American context. Who runs the company? The board is on the screen right now. We're very experienced. In my case, I've gone through the startup and exit before. I'm an American citizen, might not sound like it, but I had a very big software business in the Americas that we sold to a listed American company about 5 years ago. That's my background. I joined Openn to help them get their product into market and grow from there. On the board, we've got Wayne Zekulik, our chairman, experienced investment banker, very experienced board. We've also got Danielle Lee, ex-ASX lawyer, Peter Gibbons, one of the founders, investment banker on the property side. So we are very, very experienced. Hopefully, we know what we're doing. Oh, what happened there? I'm going to skip forward a bit and talk about what you're all very interested in. So the North American opportunity for us, we were pulled into North America. It wasn't us really pushing our way in. We joined a program run by the National Association of Realtors called Recce. That program was here in Australia, but they invited us into the Canadian Recce program. It was the first company that had gone into multiple Recce programs globally. And the reason they pulled us in there is because there is a massive push by consumers and the Department of Justice in the United States, the equivalent in Canada, towards transparency in the real estate sales process. And what's driving that is a series of court cases, judicial programs that are targeting the real estate industry. So the big national bodies in the United States, some of the big multiple listing services, and also some of the major brands. And it all boils down to the opaqueness of the way the process works. It's that private offer process that we mentioned before. They're looking at transparency as the way to solve the problem. The Canadian Real Estate Association partnered with us earlier last year, in April last year, and the reason they did that was because there was a massive consumer push towards transparency in Canada. It led to a political activity that resulted in the ruling Liberal Party in Canada pushing an election campaign platform of banning what they call blind bidding in real estate. As a consequence of that, the Canadian Real Estate Association partnered with Openn, and we announced that partnership the day before the last federal budget came down, simply because in that budget, legislation came into effect to ban blind bidding. So we've been pulled into Canada. We've spent a lot of time researching the market, getting our product ready, and making sure that we had the legals right, the sales structure right, the pitch right. 3 weeks ago, we launched our product in a soft manner, meaning it was a heavily controlled launch with selected agents. And on Monday this week, the Canadian Real Estate Association and Openn launched formally. And what that means is we have a deep integration with Korea's product called Realtor.ca. Realtor.ca is the dominant listing platform across all of Canada. It is the number 6 real estate website in all of Canada, above, I think, CBS. It's massive, incredible reach into all consumers across Canada, and it has, the CREA organisation has 160,000 agent members. As a consequence of that, we've got access to educate consumers at scale. We've got access to all of their 160,000 agents at scale. And the opportunity for us here is the integration with Realtor.ca and CREA does two things. One, it puts Openn on the Realtor.ca platform. So that's live today. And two, any agent who signs up who is a member of CREA can log into Openn without us doing a thing. So we don't have to validate they're an agent. We know they're real because that all goes through CREA. Consequently, we have a complete scalable business model. We've got a pathway here to access market at scale, and our revenue opportunity is essentially to charge a subscription of somewhere between $20 and $50 per agent who subscribes. So of those 160,000 agents, if we can get 25,000 over the next 18 months, which is our target, we're into break-even territory. Right now, we're looking to onboard 3,000 by June. We have that already in our pipeline. This is growing, and it's growing fast. Thank you.
Thank you, Duncan. We're honored to have a distinguished panel of experts with us today, each of whom brings a wealth of knowledge and experience to the discussion of corporate finance, M&A, and IB trends prediction of 2023. Please welcome Lel Smits, co-founder and executive director of the Capital Network, Niv Dagan, founder and executive director of Peak Asset Management, and Stephen C., founding partner of INP Capital Inc.
Hi, everyone. It's great to be here, and we have got a fascinating panel ahead. I will be moderating, but these are our experts. And I think before we start, just to give us some context, we'll ask them just what kind of investments they are focused on their day-to-day lives. So we have Niv and Stephen. Perhaps if you can tell us more, Niv, starting with yourself, day-to-day, what investments are you looking at?
Yeah, so I run a boutique investment management corporate advisory business called Peak. We're Melbourne-based, spent a few years in North America. That's opened the North American market for us, and luckily got back before COVID. Our model is all about co-investing and putting curated deal flow in front of investors, and those investors might be high net worth investors all the way to your small cap funds, institutions, family offices that we co-invest alongside them. Predominantly small caps, IPOs, capital raises, ASX and Canadian exchange.
Wonderful. And Stephen, how about yourself? What investments keep you busy during the days and weeks?
Yeah, so our firm is in Canada, so Vancouver and Toronto and Sydney, Australia, and also we opened a new office last year in Singapore. So we focus on technology themed investment, have a venture deal and private equity deal, and also involve your IPO and some of listed company post investment firms. So we focus on AI, environmental, clean tech, and food tech, and also 2B digitalization services. So that's our main theme. But for the early stage investment, we're basically industry agnostic. So we're more focused on the team, on the technology and solution, which change the world. Yeah.
Absolutely exciting stuff. So
Yeah.
as investments are, so you're both dealing with a diverse range between yourselves of companies and executives when it comes to assessing the long-term potential of acquisition targets. What kind of factors are you looking at to assess a company's long-term potential? Stephen, perhaps with yourself.
Yeah, I think the first is a strategical fit. I think that's very critical for the long-term success. And also the talent, so basically the management team, how you integrate the team to your existing structure and also your market proposition as well. So that's very critical, I think, matter for us to look at whether that M&A will make sense for the longer term deals. Of course, financial is is the foundation. The cash flow, revenue. That's of course, but I think for the longer term, we're more focused on the strategic value and also the team. Yeah.
Great. And Niv, yourself, what long-term growth factors are most important for you?
Yeah, I think what Stephen mentioned is spot on. I think just the integration and the synergistic angle. I think obviously sort of the market has been tricky for a lot of these small caps. So you just want to make sure that you don't overpay. There's some companies right now that are trading at, call it 0.5 times revenues, and the market has shifted as more companies are moving or trying to be moving to cash flow positive quicker. We've seen sort of private equity and larger groups come looking in the ASX, especially some of the beaten up technology companies we spoke to before, where you've got stronger US dollars synergies rather than be listed. Then we're moving away from, call it the ASX, and privatizing those businesses. So M&A is very ripe and probably be a big theme. I mean, just to put things in perspective, 2021, I think there was 210 IPOs. Last year in 2022 was around 85, and this year probably will be half that. So look, we're seeing private companies going out more for M&A consolidation relative to, call it IPOs as an exit.
Yes, well, that brings us to our next question, trends and themes. You've hit on a really big one then there that is, of course, the changes in IPOs. Stephen, do you see any other trends or themes shaping up for the year ahead?
Yeah, I think our view, like the IPO markets will be quite slow to recover, but some opportunity maybe in the second half. I think it will be really interesting company have well bottom line and top line that may have a chance. Depends on the mood of the market as well. But what we see, since last year is a lot of M&A, especially listed company, using this time to do, M&A for either cash flow or market or customer acquisition as well. Because private company now, a lot private company facing the cash flow problem. So it's a good time to pick up some good quality with reasonable valuation. And then if you do a very good integration, I think that will really give a listed company a value added and also increase the story and the valuation or the market cap for listed company as well.
Yes. So while IPOs may be off their recent peaks, are there particular sectors that you think may be of more interest to investors in the year ahead? Or when it comes to, I know you're predominantly focused on tech, so perhaps Niv, when you're looking at sectors, which do you think present the greatest upside this year?
I mean, one sector that we talked to just in the room before is cannabis. I mean, sort of really interesting. There's obviously the market had a huge boom when I was in Canada in 2018, 2019, and now a lot of these companies are really struggling to stay alive. So we think those companies, and there's only probably a handful that are sort of moving towards that cash flow positivity. The market's still good. The market's still growing, especially for medicinal, right? But we expect a lot of consolidation in the medicinal and the cannabis space as a whole. Financial services. I mean, we went out for dinner with two execs last night, or a few of us, and we're just having a chat. There's going to be a lot of opportunities and consolidation among brokers and banks and insurance companies, essentially, as things progress. Because instead, the market here in Australia is small, and it's all about looking global. Technology, obviously, and Stephen can elaborate. So that there's, we're expecting a lot more consolidation in the next 12 months.
Now, while on financial services, the collapse of SVB Bank, of course, we haven't been able to avoid. Do you think, has that changed all your outlook for investment in the year ahead, or how have you adapted perhaps your perspective on trends and themes in the year ahead because of the recent concerns with banking institutions, Stephen?
Yeah, I think SVB, I think events, I think is short-term pain. I don't think that will have a fundamental impact on, the global banking system. So I think it's just like give us a alarm on those kind of like the bank rely on startup or tech focus money, which went through a high, and then facing the capital, we call the capital winter, right? No one really can raise much capital, and that model, whether it will work in future or not, that's I think a big question for all the kind of like innovation on the kind of banking system, or new bank need to rethink about that. And I thought also from the regulator, they need to think carefully about how they regulate this type of a bank. I think Australia will be a very good example. It's very highly regulated. I think they can avoid this situation, but also that kind of limit the banking innovation or development. So I think it's kind of double, like a thought. You have good or bad, but from our experience, I think in the future, still more regulation will come out, but will kind of give the innovation a bit room to grow, because the technology can't avoid technology to apply into the banking system anyway. So it's a trend. It's AI. It's everything coming into this banking system.
But Australia's in a bit of a different position. I mean, in the US, I think there's 9,000 or so banks. Australia's, obviously much less than 100.
Yeah.
So I think, with Basel and tier one capital ratios and stress test, the Australian banking sector is in a much, much stronger position. We saw obviously Credit Suisse and UBS look, some are saying that it was forced by the central banks in Switzerland. Some are saying it's a good deal, but to pick up Credit Suisse at 25 cents in the dollar equivalent, with all the loans and guarantees guaranteed by the central banks, just incredible, right? So, yeah, look, there's going to be once again a lot more consolidation that we expect, but I think things are different in Australia.
Excellent. Now, in your answer, Stephen, you mentioned some emerging trends for technology, also AI, which has been on the headlines specifically this year. What are you specifically looking at when it comes to technology investment that you think will perhaps characterize the year ahead?
Yeah, I think two themes we focus, well, let's say three. AI, definitely generative AI is a big theme, and also based on that, how we can apply into the business world, not just a kind of like engine for you to entertain. You're doing your homework or doing nice stuff, but how that can apply into business automation, and how can help business save the cost and improve the efficiency. The second bucket we see is more focused on the clean tech or environmental tech, especially like a waste management or how you make the world more cleaner. I think that's our theme for that. I think that might have more IPO opportunities, because that's kind of a separate sector. Everyone, a lot of like capital focus on. The third one is new energy, but new energy is very big topic, but we focus on the EV cars, more like a commercial application, for example, mining, transportation, logistic. I think that part have a huge opportunity to kind of get more greener environment impact, and also a lot more efficiency into the business.
Fantastic. Well, you both mentioned so many fascinating trends in the year ahead, and I suppose bringing it back to implementing and working to maximize these trends, you work with clients and companies daily, manage their expectations and move through the process of investment and M&A. When it comes to the relationships between yourselves and your clients, how do you, perhaps starting with yourself, Niv, manage expectations with your clients over what they can expect in this investment environment, and still help them to continue growth?
Yeah, majority of our clients are wholesale sophisticated investors, so they understand that markets go up and go down. But look, it has been a really, really tough probably 12 months, or more specifically the last 2 months. I mean, January was a really good month for small cap, nano cap equities. I mean, we had the small cap index up about 10 or 12% during that month. It was a huge month. And everyone looked like heroes. And now the last 2 months has been really, really tricky. I mean, we caught up with a lot of fund managers and brokers yesterday here in Sydney, and a lot of aren't doing anything. Investors are sitting on their hands, and probably the best asset class right now is cash and cash solutions and fixed income. So, look, the tide changes very, very quickly. I think once the market, there's some certainty that interest rates will have leveled and start to reduce, inflation stopped out, confidence starts to come back into the market. It's good to see central banks around the world coordinating liquidity. But absolutely, it is a tricky environment. And when you're in doubt, my view is always stay out.
Excellent. Stephen, yourself focused on technology and clients that are working in that space. How do you manage their expectations? And again, perhaps explain what's happening to them in this environment.
Yeah, I think it's tough for everyone. So our investor base is similar, like all wholesale investors or installs. So they understand the market, they understand how this happened, but everyone doesn't like lose money, or at least you see you didn't earn money. So I think for us, it's transparency is very important. So it just kind of like be brave, on time or proactively for the communication. So what we see from the portfolio company, how they performed and how they react or prepare for this or execution under this environment. And then the second part is just like to highlight some like very good quality deals, good quality, opportunities, which can have the opportunity, have that liquidity events in, next 12 months or 12 to 24 months to still keep them involved, engaged in this, the technology involvement. Because I just came back from Hong Kong. So yeah, it's like Neil mentions, it's a lot of fund manager now. It just choose not doing anything, looking for kind of like a fixed income or very conservative option. But because I think it's SVB and also the First Republic Bank, everything kind of like very panic to create this kind of the mood. So everyone wants just like wait and see mode, but they still see for the prime market a lot of value, valuation reasonable, good quality company have achieved the cash flow positive, revenue growth. So I think they still confident on that, but it's very specific deal, not just say okay we invest 10, 20 deals this year. It's maybe just one or two. Yeah.
Yes. So amid these challenging conditions, and as you mentioned, investors perhaps sitting on their hands and not wanting to invest, if we put the focus back onto the companies, there are companies that want to raise capital, need to raise capital. What are perhaps some innovative funding approaches or strategies that you may have seen that you think is, perhaps stood out, or is something that you think was an interesting way to get the attention of investors? Neil?
Yeah, I think it's a buyer's market. I mean, I'll give you an example. We caught up with the CEO of a gold explorer who's been suspended for a few months on the ASX because they had a crusher and they had to get debt, and the last price was 2.6 cents, etc. And I said to them, well, we'll give you money at a 75% discount for the last price. And he, the CEO just balked and he said, that's, we're worth a lot more. And I said, well, if you were actually trading for the last 3 or 4 months, your stock probably would have been one and a half that. And it's a buyer's market. So there is capital to deployed at the right price, and investors should be patient. That's my suggestion. I mean, so in terms of funders, yeah, look, guys like us and Stephen, or crowdfunding is an interesting source, or different platforms, essentially with a retail high net worth investor base. I think it just comes down to the opportunity.
Excellent. Stephen, yourself.
Yeah, I concur with Nave. But one thing I think we can think about is the SPAC. In 2021, basically U.S. listed more than 200 billion. Worth, SPAC. which is special purpose vehicle. They actually looking for deals to close. Otherwise, they have to return the money to the investors. So I think that might be some opportunity for, good quality company to looking for, kind of dual list in US or have a, kind of IPO opportunity to look for this opportunity, talk to this back. They may see some value there because they have cash, on hand. So it's as long as you got good business model, you got bottom line, or even you have pathway to your cash flow positive, they may see the chance. So kind of solve your funding problem.
So SPAC, for those here, I mean, it's a special purpose acquisition corporation with a huge amount of cash, like a shell looking for assets. And what Stephen's saying, that if they don't act in a certain amount of time, then they have to return back the capital. So there's a huge sort of inflow in probably 2020, 2021 in SPACs, and then they lost a little bit of the shine. But we are seeing actually companies here on the ASX delisting and looking at different sources of funding.
Now, as we know, money never sleeps. And in financial markets, I feel almost weekly I'm getting an email that says urgent, urgent, urgent. How do you both manage the need for speed and flexibility when it comes to raising capital, with also the need for due diligence and risk management, in particular in these times when markets are a bit more challenging? Niv, have you had any recent experiences where you've had these two issues conflict?
We've got a company now, I won't name who it is, but that is a large phosphate company, and it's interesting what's happening with the lithium-ion batteries moving into lithium phosphate. It's cheaper, it's greener, it's cleaner, and it's longevity. But the company itself needs to raise capital because they realise all these companies moving to now the 30th of March and going, hang on a second, our quarterly report isn't going to be very good. And we need to shore up the balance sheet, because as soon as companies are trading, call it come raise, the market sniffs they need to raise capital, the stock price falls. So look, it's an definitely interesting time for companies across the board, and those companies that are ahead of the pack and can restore the balance sheet on a back of strength, not weakness, are going to succeed. And those companies like this specific phosphate company or the Gold Explorer, who's been suspended for 3 months, I'm not saying that they won't be able to get capital, but it's going to be at a pretty ugly type scenario where we structure it that we can't lose.
Yes. And Stephen, yourself?
I think it's the most important, the company or the management have to be proactive, basically be prepared to raise money every day or on specific day, because the market now very volatile. For example, if you prepared and then you can raise money maybe in January, February, that's a good market condition. People are positive. You may have a good, valuation or market cap or price there, right? But if you need money, for example, by end of March, but now you come to the market, realize that I don't think you will get a good deal, with all this happening. So, what we talk to our portfolio companies is just, you just prepared and then get ready for, you not raise money you need, but just more raise money you can go through the cycle. So we have 3 companies actually raised money last year, raised additional capitals up round. Basically, they don't need that money that much, but they just foreseeing they may have very tough situation this year. So they cut off doing early. And then I think that's a good approach.
Yeah, absolutely. Yeah. I have an investor relations firm, and we always say to our clients, it's harder to get a new investor than to keep your current ones happy. So you just want to keep working on making sure what you have is in a good place and not get to the point of desperation.
Yeah, that's right.
So when it comes to, I suppose, speaking about that, common mistakes that we may see either from companies or perhaps we'll start with companies. In particular, in this environment we find ourselves in, what are some common mistakes that you have seen from companies?
Well, that one company that I mentioned about the phosphate company, the stock actually, we raised some capital last year. The stock actually went up 4x since we raised capital. And we were playing golf in a charity event, and we rang the CEO and we said, Brett, you should take some capital here. But, And he said, no, it's going higher and this, and now he's going to be raising capital at exactly the same level of where he did when we came in. So I think management needs to be realistic. I think they need to always shore up the balance sheet, and that gives them a flexibility, as Stephen said. The second thing is just not over leverage themselves. I think debt is, look, we've seen a lot of companies that, have their debt to equity ratio above that 100% or even higher. And, debt's now expensive. I mean, we caught up with another company that is in the fishing industry, and they're going well, but they're about to get a credit line from NAB. This is National Australia Bank, 600 basis points above the RBA. I mean, so, it's not that cheap because all of that interest goes directly to the bottom line. So if you can't sustain, so I said, my tip to avoid companies, obviously take money when it's there, if it's on the right terms, on a position of strength, and don't over leverage.
Excellent. Stephen, yourself, what are mistakes you see from companies, and perhaps some advice for avoiding those mistakes?
Yeah, I think it's the first day, sometimes, I think it's overestimate their value, or, the efficiency, how they get the customer, because the economy is a system. So, when one part not work well, they will impact all the parts. So some of the company, we talk to the founder, they say, oh yeah, our customer very happy. Our solution save the money. It's a SaaS company, right? But all this coming, and you will see, it's hard to onboard new customers, and it will take much longer, to take new customers. So that means your revenue cannot grow and still burning money. That's very risky. So I think the first, as you mentioned, be realistic and be more conservative on, in the next 12 to 24 months. Don't think, the market will give you a V-shape rate. I don't. From my point of view, I won't see any V-shape recovery, for this cycle. So, just be realistic, be, prudent, and then to be prepared every time to go to the customer or investor, just keep, them alive. And I think that's important.
Fantastic. Well, I think on that very positive note of advice from you both to the companies, that will conclude our panel. Thank you so much, everyone, for listening in, and hope you've gained some expert insights as I have. And thank you, Niv and Stephen, for presenting here today.
Thank you.
Thank you very much. Thank you.
Welcome back, everyone. I hope you all had a great lunch and enjoyed networking with each other. We're thrilled to have with us today a renowned expert in the field of business transformation and the future of enterprise. Please welcome Friska Wirya from Fresh by Friska.
Thank you so much. Just testing that works. Yep. I wanted to ask you all a question. Is your organization future fit? What does future fitness even mean to you? Renowned futurist Alvin Toffler said, "The literate of the future will not be those who cannot read or write, but those who cannot learn, relearn, and unlearn." To be future fit, we need a fluid and flexible mind that seeks out change over comfort. We need the willingness to adapt to today's methods instead of relying on yesteryear's approaches, like some old school managers who are still measuring hours instead of outcomes. Now, for most organizations, future fitness means transformation. And since the global pandemic, everyone's hopped on the tech bandwagon, investing in virtual collaboration tools, automating low-value processes, or leveraging ChatGPT to accelerate content creation at scale. A 2021 Fortune study stated that 85% of organizations are putting their foot on the gas of transformation. That's a lot of change that we're expected to deal with, get our heads around, and lead our people through. Ironically, although change is the only constant, that 80% failure rate of change initiatives, it hasn't budged for decades. It's almost like change itself is resistant to change. Our ability to absorb information has plummeted to 2.5 times less than pre-pandemic levels. We all suffer from constant information overload, dwindling attention spans, and that intensified pressure to always be doing more with less. So should it be any surprise then that the success rates of enterprise-wide transformation, they're really bad. They're in the single digits. Such a measly success rate would be unacceptable elsewhere. Can you imagine if a surgeon only successfully operated in 3 out of 100 patients? Or if Viagra was effective on only 3 out of 100 dates? That's 97 wasted dates and a lot of very disappointed people. These numbers won't change unless we change, unless we stop traversing the path of least resistance, which is this inane knee-jerk autopilot spending on more tech. It's not the tech that's failed. It's the people side of transformation that's been neglected. Our love affair with the latest and greatest technologies means we've forgotten the tool is only as powerful as the people who are using them. Imagine the most sexy, high-performance sports car in the world. Toyota Prius, right? Okay, all jokes aside, I have better taste than that. I'm sure many of you have a red Ferrari in mind. Now visualize your granny driving this powerful beast. Here she is. Now, if F1 driver Daniel Ricciardo was behind the Prius, do you think he'd beat Granny around the track? He definitely would. A couch potato in the most advanced, newest Nikes, they ain't going to be winning any marathons. But yet, we all walk around thinking future fitness is determined by the tech stack. Right? What about the people stack? Picture an actual people stack. Giant human Jenga blocks stacked on top of each other. And just like Jenga, if you remove the wrong block, the wrong skills, the wrong mindset, that tower of transformation is going to come crumbling down. So instead of only worrying about malware or the metaverse, we need to reverse Jenga our people stack and start building on how they think, make decisions, and manage their emotions. When I'm hiring the dream team, I'm looking for 2 key traits: openness to change and assuming positive intent. Why? Because these are traits that enable transformation to come alive as people explore and experiment with new technology. Extended reality, ER for short, is an emerging technology that combines tech and people, and it turns it into something even better. It adds digital elements to our physical world, making it more vivid, more exciting, and it includes AR and VR. Now, you may be thinking, oh yeah, seen it around, it's relatively new. But it's actually not, because movies such as Lawnmower Man, Virtuosity, and Existence, they've all featured elements of ER from way back in the 90s. But real-world adoption was slow. Nothing happened for 17 years. Then, ER started to go mainstream. In fact, the sector's growth over the next 5 years is 58%. Comparable to the RBA's interest rate hikes, right? I must say. Why this growth? They started to build their tech around people, not the other way around. They improved its user-friendliness. They sought to deeply understand human needs before even ideating how ER could meet those needs. ER has unbridled potential to reimagine many industries. In tourism, imagine straightening the Leaning Tower of Pisa, seeing the Sphinx with its nose detached, parting the Red Sea with Moses, or feel what it's like to hurtle around the F1 track with Ricardo in the not-so-sexy Prius. In the next crisis, and yes, there will be one, ER can enhance our sense of presence and connectedness, of truly being there together. Did you know it's already possible to attend and participate in VR meditation sessions, church services, comedy nights? You can feel like you're right there in hysterics with your BFFs. How different would Melbourne be today if they transformed the global pandemic response and used ER to combat feelings of isolation, loneliness, and depression? A newer gaming generation has spawned that's hooked on ER's immersive first-person experience. It's getting more accessible and affordable, with cyber gloves, air glass, and AR glasses supporting head touch, voice, and gesture control. They're already saturating the market. Right? With these gloves, we can live our best Minority Report lives, our digits controlling all things digital, manipulating floating images like an orchestra conductor. But if you don't know how to use these tools, then these gloves may as well be Elton John's bedazzled weightlifting gloves. During my time leading the transformation of the largest gold miner on the ASX, AR was used to train autoclave operators. You may be wondering, what on earth is an autoclave? It's not so much on earth, but rather mined earth containing gold. It goes in it. Think of a 4-story oven that bakes precious metals instead of cookies at temperatures and pressures more intense than anything found naturally in the atmosphere. It's a dangerous piece of equipment, even if you know what you're doing it. So AR overlays of the autoclave were created and inserted into training programs. The location was Lihia Island in Papua New Guinea, right, where humidities reach upwards of 90% and temperatures average 32 degrees Celsius. It really does look like the love child of Avatar and Jurassic Park, right? Lush tropical jungles, tropical fruit trees, just minus the blue aliens and dinosaurs. The operators, local Papua New Guinean men who often left their remote mountain tribes to work in mining, could now learn about autoclave operation from the safety and comfort of the office, using VR goggles. I actually tried the training myself. I remember it was a cold and miserable winter's day in Melbourne. I had 2 pairs of tights on and my trusty black puffer jacket. And it was surreal. I felt like I was actually back there, hundreds of meters in the air, walking along the suspended steel beams. I saw the instructor so clearly in front of me, talking about the machine specifications. The sun was shining, and my brain knows this is physically impossible, but I swear I actually felt that island heat on my face. Because of the experiential nature, operators retained 35% more information. Safety and productivity improved as they had a familiarity with the site before setting foot in it. The technology molded to the people stack, developed around their needs, wants, and traits. It worked. But it all came to a grinding halt. Even though this tech could be used for remote expert assistance or be replicated to train other people in other high-risk roles, that lack of continued focus on the people stack meant that next transformational leap forward just never happened. There wasn't enough openness to change and positive intent to explore more of the unknown, to push through resistance and combat unspoken fears. These examples illustrate why embarking on an enterprise-wide transformation without equal, if not more effort to the mindset change that comes with it is the same as putting little old granny in that powerful new Ferrari. Its full capabilities won't be used. She'll be shifting those tectonic gears at the pace of tectonic plates coming together, toddling down the autobahn like it's a school zone. Part of the problem is conventional thinking. So instead of defaulting to, have I got the right tools at the right time and did I pay the right price? Focusing on the people stack raises more pertinent questions such as, what does a day in these people's lives look like? In which situations will this technology help make life easier, simpler, more efficient, maybe even a little more fun? For organizations that over-index on tech, the lesson will be bittersweet. Sweet, there may be some initial benefits. Bitter, they'll be short-lived. One thing that's never bittersweet, dining at a Michelin star restaurant. Until you're the one stuck with the bill, that is. I remember being one of just 8 diners at an iconic restaurant in downtown Tokyo, globally renowned for its gastronomical theatrics. I zoomed up the glass elevator to the 38th floor of a 5-star hotel, the twinkling skyscraper lights below me. First, you're ushered to sit and presented with a tiny toolbox containing a miniature hammer, shovels, tweezers, a tape measure, and the menu is so sleekly printed onto it. I thought to myself, is the chef an elf? But then the 14 dishes presented themselves with increasing intricacy and complexity. These delectable morsels are made right in front of you in real time. I felt like I was watching a culinary David Copperfield show from the front row. What they were able to create was magic. You see, restaurants are the same as our organizations. We have access to the same inputs, people, process, tech. But Michelin star kitchens are culinary autoclaves. They ingest these inputs and apply more passion, pressure, and precision beyond what is normal to create an abnormally stellar result. The Michelin world has cracked the code. They fortify their people stack with the support systems and structures for them to thrive. Surely we can improve transformation success by adopting their people-first approach. My career has seen me bring transformations to life in 6 of the 7 continents. I've developed a toolkit of frameworks, processes, and models. But what really amplifies future fitness is applying these 3 principles of PRISM, play, and production. PRISM. If we view transformation through the prism of the human experience, it refracts into a rainbow of possibilities. Diversity. The full spectrum of cognitive ability and human emotion makes a people stack not only more beautiful, but more likely to succeed. Play. Even the biggest Luddites will be enticed to move to the bleeding edge of tech if we give them the right environment. Even tribalism can turn into transformation when curiosity is stoked. People will play. Production. What separates the Michelin from the meh is that expert orchestration of talent, teams, and technology. Make no mistake, it is about putting together a complicated, star-studded production. The truth about mastering transformation is that really it's all about mindset. Because the future fit organizations are those that reverse Jenga their people stack, focus on readying instead of resisting, and are helping their people learn, relearn, and unlearn. I'm sure Alvin Toffler would agree. Thanks.
Please turn your attention to the screen as we welcome James Graham, CEO of Recce Pharmaceuticals Ltd, ASX code RCE, FSC code R9Q.
Hi, I'm James Graham, CEO of ASX and Frankfurt Stock Exchange listed Recce Pharmaceuticals Ltd. Usual forward-looking disclaimer. So, who is Recce? Recce is a wonderful wealth of good people supporting great science. Dr. John Prendergast, who some may know as a New York Stock Exchange biotech chairman, in fact, a former Australian with his doctorate in the study of microbiology, bacteria, and infectious disease sciences. I'm not supposed to pick a favourite among these, but hey, let's talk about Dr. Alan Dunton, former global head of Janssen Research, which is the Johnson & Johnson research arm. He, in fact, led Roche's clinical trials globally, and it was the last person to have a, not new class, but a reasonably new antibiotic approved some 12, 15 years ago. In fact, in the first year, that went on to be a blockbuster drug of about a $1 billion in sales in the first year. So pleased to have Alan's support. So what is our company about? Our company has the most advanced new class of antibiotic in the world at this time, is in fact the most advanced clinical stage sepsis drug in the world at this time, and is tackling a major capital market or major market of around $40 billion in size. That is growing. Everybody likes a growing market, me included. It's growing at about 2.5% per annum, and Recce is coming in there with a new product servicing unmet medical needs of large patient populations. We wholly own our compound and this unique technology. We have patents out to 2037. We have an FDA qualified infectious disease designation supporting our sepsis drug candidate. To my knowledge, we're the only one in the world with that for that particular designation for that indication. That gives 10 years of market exclusivity above and beyond patent position, which is very valuable to us. We have a number of clinical candidates at this time in various phase 1 and phase 2 statuses, depending on the method of administration, focused upon urinary tract infections, focused upon urosepsis. 30% of sepsis patients start as a urinary tract infection, and focused upon topical applications as well, broad spectrum burn wound infections and broad spectrum diabetic foot ulcers, where we have a study out at New South Wales Liverpool Hospital at this moment. Is it a problem? Well, the key opinion leaders, being the global clinicians, certainly say so. Here we touch upon the lack of new antibiotics threatening global health as we know it, and how Recce seeks to address that market need, not contributing to antibiotic resistance and potentially supporting the existing antibiotics as we know it. How do we do it? We have a unique mechanism of action, different to every other antibiotic known to date. We stop the ATP synthesis or beating heart of the bacteria faster than any other antibiotic before it. We stop the cell division, or the Z-ring complex being the way that cells divide or infection spreads, they multiply. We stop that, and we stop it irreversibly, as well as a number of other mechanisms. Effectively, any bacteria in your blood, by example, which is sepsis, bad bacteria, we bind to it, interact with it selectively, leading to obviously better patient outcomes. This slide, if it plays, which it looks like it will play, is basically showing our ability to discern between healthy cells and unhealthy cells, or bacteria. These are E. coli bacteria. So those little squirmy ones are bacteria multiplying uncontrolled. The larger ones are healthy eukaryotic cells. With exposure to Recce, what we have is the healthy cells continue to grow uninhibited, while those bacterial cells don't. If we think of them like the ally and the enemy, and you want to hit your enemy without harming your allies in the process, that's exactly what Recce is about. No such thing as good bacteria, certainly no such thing as wanting E. coli in your vascular system. And this demonstrates an ability to have a specific mechanism of attack. Here is a comparison against Staphylococcus, just a different type of bacteria. They grow a little slower, it's just the nature of them, so not visually as exciting, but clinically extremely important. Here is E. coli, designated by a biofilm. Clearly, the four most common antibiotics here don't respond, or the bacteria isn't susceptible to them. With Recce, it is, and it is quickly, and that is extremely important for stopping infection in its tracks. We have a significant portfolio of activities focused upon unmet medical needs, meaning not serviced by any existing antibiotics, certainly not serviced by inexpensive generics. And we have near-term clinical milestones and inflection points that we are working very hard in the background to ensure their achievement, and greatly looking forward to those results. Sepsis, the primary drug focus, it's just for background, it's a major patient population, about 50 million cases worldwide each year. It's a 1 in 5 death rate in the community, or a 1 in 3 in hospital. 1 in 3 in hospital. It's the #1 most expensive condition treated to date, double the second most expensive. Here are some recent drug pricings to put in comparison the patient population to the opportunity that, if approved, a number of years away still, of course, could be available to us. So the lower tail end there is obviously for urinary tract infections. The upper side of things is for your broader spectrum infections. In fact, at one point, Exigris, and forgive my pronunciation, was developed for a sepsis drug candidate. It was momentarily approved, where actually it was then for sale on the market for about $30,000 US a dose. However, it was disapproved because they found out it didn't actually work. Long story, but that's what the market told them. Here is an example of that company during its respective activities. That this company was acquired by Arovella Therapeutics. This is an example of one of those other drugs shown as a urinary tract infection, which had a market capitalization of around $4 billion US at that time. Here's an example of a clinical acquisition or licensing deal around $500 million US in size that just happened for a very simple UTI drug. What does this story tell us, besides big dollars and true opportunity and engagement in markets around us? Left-hand side, big pharma, marketing, distribution, and cash. Right-hand side, generally speaking, little pharma, drug developers like ourselves. Big pharma come along, little pharma are there with the innovation and technology, and the two come together. They usually come together at the end of phase 2, which, given that we're in the phase 2 stage in some of our instances, is an opportune time to be engaged. This is a recent phase 1 study that we completed, demonstrating our compound to be safe and well tolerated across 80 healthy volunteers, dosed at very high concentrations of about 6,000 milligrams. We see a nice dose-dependent concentration of our compound in human plasma. We see a nice dose-dependent concentration in human urine, but the unexpected was a 20-fold concentration residing in the human bladder. Again, it's not a good thing to have bacteria in your urine or in your bladder. And of course, where there's the bacteria and method of administration gets the compound there, the two have the opportunity to connect. We demonstrate that our compound works well in urine. It's not prohibited by it, and in fact works better than any other antibiotic in that space. We have granted patents around the world supporting our composition of matter, method of manufacture, methods of administration, and surrounding claims. We manufacture our product at our own facility. You know, the vials cost more than the liquid that goes in it, and we're making to both volume and quality standards for our present and future clinical studies. We've got a market cap of around $100 million US. We are delivering on our near-term clinical milestones, which our cash is well placed to support. And we are basically an infectious disease company getting ahead with a new class of antibiotic candidates targeted at major unmet medical needs, servicing the global infectious disease population. I'm James Graham, CEO of Recce Pharmaceuticals Ltd, ASX RCE, and thank you for listening to our presentation.
I hope everyone enjoyed that. Next, I'm delighted to introduce our last keynote speaker of the day, who is an expert in the field of IPOs. Please welcome to the stage Amit Verma, Listings Manager of ASX.
Thank you. Let me just check this thing is working. Yep, perfect. Here we go. Hi, everyone. Like said, I'm Amit Verma. I'm with ASX. Have a long history in the private markets. Part of the new IPOs and new listings team. So we work primarily with private companies and educating the market about what is entailed to be a listed company. What are the pros and cons of potentially being a listed company? And I'm going to talk a little bit about that today. So before I start, are there any founders in the room? Or yeah, okay, and okay, that's pretty good. So today's I'm going to talk initially about a little bit about the concept of listing and why you should list or why you shouldn't. Then I'm going to talk a little bit about the ASX itself as a market. And then finally, more about the mechanics of listing. And I'm going to make sure that I finish in time. Right, here we go. So the first thing I think when we meet companies is we talk about the concept of, is listing the right thing for you to do? Because as a founder or as a CEO, you got to make sure that the company is in the right stage, the right state, and has the right characteristics to be a public company, because it's not for everyone. And contrary to popular belief, we don't tell every single company we meet that you should list. In fact, we do tell companies that we come across that perhaps listing is not right for you, and maybe not at this time. And these are the steps you need to follow to potentially be a listed company. So these are some of the things you can potentially think about when you are looking at whether listing is an option for you or not. So the first important thing is that what's sort of your growth strategy? Do you want to be raising? Do you want to list to raise fresh capital? Are future acquisitions in your sort of roadmap? Because you can use shares to acquire companies as opposed to cash only. Do you want to use the public markets as a mechanism to sort of lift your company profile? Because that can help a lot. Institutional investments, some of the most blue chip and tier one institutional investors, they often invest only in listed equities. So if you want to access some of that capital, then being a listed company does help. It's easier to reward employees when you're a listed company through shares. And finally, what listing also means for your customers and suppliers. We come across companies often that are doing business in Southeast Asia, whereby in order to win certain government contracts or certain key customers, it helps if they're a listed company versus being a private company. And we hear that quite often from those markets. So this is a section on sort of when can you IPO? When's the good time for you to IPO? So obviously, everyone's probably seen this traditional funding cycle chart where you have companies going through their different stages. We believe that when you're sort of at that Series B onwards, and market cap of probably around 150 to 200 million plus, that's probably potentially the right time for you to start thinking about whether you can list or not. We do get companies sometimes that are quite a bit smaller. Now, if you look at the listing rules from the ASX, you can list a company with just 15 million in market cap. That's 15 million. However, we believe that that's potentially quite small. That amount is more for companies coming out of the mining sector. It is quite acceptable in that area to have companies of that size. However, if you're a technology company or a healthcare company, we believe that, you should be in the order of sort of 150, 200 million plus, at least 100 million at the least. And one of the primary reasons for that is those institutional investors I spoke about earlier. They would not be interested in investing in a company that is sort of below 100 million in market cap. So that's typically where we would like to see that. And here we go. So key ingredients for a successful IPO. It is a process. Typically, we would say that you would want to allocate at least 6 months to an IPO process. Often companies take even longer. So there are a number of steps involved. Obviously, one of the first things you got to do is have a very sort of clear understanding of why you want to list. What is the growth story here? Because it's much about storytelling to the investors and storytelling to the market as it is about the technical side of raising capital. You need to make sure that you've got global operations and scale, because investors want to see opportunities for the company to grow into something large, into something big. Hence why being a global company is often more attractive to investors as opposed to being just a local business. Team is extremely important. Many of you have put your hand up and your founders, and if you've raised private capital, that's one of the first things that private investors focus on, is what is the makeup of the team and what's the quality of the team. It's no different with public companies as well. The key, the exco level, the management level is quite critical. Significant assets with a clear path to revenue to profit. That's a typo, that there should be profit. So we've often seen especially with technology companies in the last few years, the story was all about growth at all costs. And that narrative is flipped. Certainly in the last year, the narrative is flipped to, yes, we still want your companies to grow, but we need you to manage your burn better. We need you to manage your margins better. And where is that line to profitability? In fact, technology is one of the only sectors where you can actually list a non-profitable company and still have a pretty good outcome. However, investors now do want to see, is the company profitable, or if it's not, when potentially might it become profitable? So that's a key shift we've seen in the market in the last year. Advisors are quite critical to the whole listing process. So we often tell companies that, of course, we can be your first port of call to have a quick chat with you about what the journey might entail. However, you need to then make sure you're speaking to the right people. So your right ECM lead managers, and some examples of them could be Macquarie, or you've got the UBS, or these are the bulge bracket ones. And then at another level, you've got the likes of Bell Potter and Ord Minnett, which are more sort of Australian-based advisors. They often would help you. You need to have a strong ECM legal team with you as well. And then essentially they'll work together to create the prospectus, to make sure all the regulations are right, all the approvals are done from ASIC, etc. And then they can start beginning the roadshow and talking to investors, and typically what's known as sort of a front-end book build. Right, so that sort of explains a little bit about potentially what listing looks like. I'm going to talk a little bit about the ASX now, and potentially why the ASX is a good place to list. As everyone knows, most folks are familiar with the ASX, and we sit at the heart of the Aussie financial markets. We do on average sort of 135 listings a year. And over the last sort of 6 years, we've raised about 7 billion every year. Companies have raised 7 billion every year in primary capital, and then about 51 billion in follow-on capital. What's interesting to note is that whilst 2022 was quite we had very low listings globally, the ASX still had 107 listings in 2022. And a lot of them, of course, came from the mining sector, where the demand for battery metals and other sort of precious metals is quite high. Hence why we saw a lot of companies list from that sector. We didn't see too many listings in the technology space. We did have a few, but obviously everyone's sort of gearing up for the second half of this year. That's where the pipeline is shifting to. It's a very active market. As you can see, we probably trade about 9 billion of capital every day. We do have the 5th largest pool of pension funds globally. I'm going to talk about that shortly. We have about 2,000 companies listed on the exchange for a total market cap of about $2.5 trillion. And it's a 150-year-old exchange in different formats that has now come together as the ASX. I think it was in 1987. Right, so coming back to super, this is something that does surprise people. everyone knows what superannuation is, but often they don't know how big the industry is. We have the 5th largest pool of money in the world, like I mentioned before. It is, sitting at about 3.3 trillion right now, going to 9 trillion by 2041. And a lot of this money is invested into listed equities. This is what sort of drives our public markets and provides liquidity to these markets. If you look at the sort of comparison with the other global exchanges, even though last year was quite quiet for everyone, we were second in the world in terms of new listings. We did 107. The gray charts that you see above, for example, the NASDAQ, those are SPACs. Obviously, as you know, the ASX doesn't do SPACs, and as it's turned out, with good reason. And then, as you can see, the NASDAQ did about 85, and we did 107. And very proud to say that whilst we were ranked second for new listings, we were ranked number 1 globally for follow-on capital raises. So we did over 1,000 follow-on raises. This is when a listed company goes back to the market to raise more money. And whilst the other 2 exchanges were higher in volume, we were very high in terms of number of follow-on raises. And that's another important point for founders to understand when thinking about whether we should list or not, is that it's not just your first IPO, your first time you list, it's what do you do after that? Because if you want to raise money again, it is quite seamless when you're on the ASX to go back to the market. Often it could be, within sort of 48 to 72 hours, if everything is done properly, you can have the money in the bank. This is once again, quite an unknown thing with the ASX, especially when we're talking to foreign companies. Everyone here may or may not have heard what the indexes are. But if you're an ASX company, you get access to the indexes a lot earlier. So you can get into the S&P 200, which is the Australian flagship index, with a valuation of about 867 million. In comparison, you have to be about $12.7 billion to make it into the S&P 500 in the US. And this is one of our major pitches to US companies when we speak to them, is that you can access the indexes a lot earlier. I don't have that slide right now, but the valuation multiples are about 4 times higher than the NASDAQ for that sub $5 billion band of companies. So the main message there is, in the US, unless you're a really, really large company, you're probably better off on the ASX in terms of valuation multiples and access to indexes. Just a very quick market update, as I only have sort of 3.5 minutes left. Like I said before, 22 was a slow year. 21 was a record year for most markets. We did, I think, 241 listings in 21, and we did 107 last year, which was still quite good considering what was happening globally at the time. So in 22, we did, like I said before, the secondary capital raise we were number 1 in the world. Those are some of the key follow-on offerings. I often use the word secondary, but it means different things in the different markets. So I prefer to use the word follow-on here. So we had ANZ Bank issued $3.5 billion of follow-on capital, and car sales do about 1.2 billion. So these are some examples of the follow-on raisings. This is quite an interesting chart. This is something most folks are not familiar with. Most folks don't know what the VIX is. So anyone here familiar with the VIX? So the VIX is essentially the volatility index, and most markets do have that, and we can track those. So what we've seen is that when the volatility index is sitting in between the 10 and 15 range, if you can see that sort of orangey band at the bottom, that's when we see spikes in IPOs. And as you can see, we have come off recently off a slightly higher volatile time, and we are sitting in the zone now, albeit in the last sort of couple of weeks, the VIX has started creeping up again. And I think that was to do with essentially with what, as everyone knows, what happened with Silicon Valley Bank and with Credit Suisse. We have seen the VIX creep up a little bit, but it's still sort of at that, sitting around that, between that 15 to 20 mark. And we're hoping it stays within this band when in the second half of the year, which is when the sort of predicted window is going to reopen for non-mining companies, for technology companies, for healthcare companies. But this is a key driver of activity in the market. Right. So these are some of the key listing criteria, and this is freely available on our website as well. You need to have sort of a minimum 300 shareholders at the time of listing. Now, remember, this is post-money. You don't need to have 300 shareholders as a private company right now if you want to list. Just ensure that at the time of listing, and your advisors will work together with you for that to make sure post-money there are 300 shareholders. The free float is a minimum of 20%, and then you can be a listed company whether you come in via the profits test or via the assets test. I won't go into the details of that now, but that's available on our website as well. Essentially, it just determines once you list what are the escrow requirements on any sell downs. And happy to chat with anyone later if you want more detail on that. And finally, this is essentially the listing process itself. As I mentioned before, we are often the very first port of call for companies like yourselves to come and have a chat with. But then we would quickly bring in the right folks from the markets, the right professionals. And the first group of people we will bring in is your ECM bankers and your ECM lawyers. Those are the first group of people we'd sort of suggest you talk to, because they're essentially going to do all the prep work, all the prospectuses, lodging all the applications, both with the ASX and with ASIC. And then finally, if you look at step 3, 4, 5, you've got the marketing process, which can often run in conjunction with whilst your application has been lodged with ASIC. So you don't have to wait for one thing to finish. You can actually start marketing before as well. And then at the end, the advisors would help with the book build process. And at the end of that, basically, this is what happens then. You go and ring the bell. All right, so I can see that I have 9 seconds left, and I'm bang on time. So that's our team there. We're just based around the corner. We have 5 in Sydney and then 1 sitting in Auckland, Blair Harrison, and the rest of us are all just down the road in Sydney. So happy to have a chat with anyone after this at any time if you have any further questions. Thanks, guys.
Thanks very much, Amit. And just want to say, as far as we've been working in this space for a long time, I've known Amit since 2014, and it's one of the incredible people in this space that does nothing but endlessly try and network companies with investors, as well as now obviously with his role with the ASX and supporting companies as they go through the exchange process. So thank you to you for all the work you do in this space, as well as what the work you're going to be doing now in helping companies get listed. So thanks, Amit. Now, just to say thank you very much for everyone coming. This concludes the session in the stream in room 1. We will be, obviously, room 2 is still going, and actually we're going to be hosting one of the sessions I suppose I'm looking forward to most. It's Peter Mobb's presentation is going to be at 2:30 today. So obviously presentations are still going in there, and then once those presentations are finished, then it's everyone's favorite part when we have some drinks and network and enjoy the rest of the day. So thank you very much for joining us for Emergence 2023. Hope you enjoyed the sessions, and enjoy session 2, and we'll see you for the networking drinks. Bye.